coverage protects workers' wages from employers' market power and forces the firms to share rent. In line with some other work for the US, we find that monopsony power has not increased in the UK. But we have found that a measure of worker power, weaker worker power, and following Stansbury and Summers, means that the monopsony that there is matters more. The monopsonistic labour markets that we have in the economy push wages down more, and fewer rents are shared with workers. And this may in turn explain part of the fall in the labour share and the flattening of the Phillips curve. Thank you.
Great, thank you. Now we have your discussant, Silvia Albrizio from Bank of Spain, and you have 15 minutes for discussion, and then Gregory will have time to respond to your comments. The floor is yours, please.
Thanks so much. Let me share the video. A second, small problem. Okay, are we there? Okay, thanks so much. Sorry for the time. Okay, thanks. So thanks so much for inviting me to discuss this paper by Will, Silvana, and Greg. It was a pleasure to read it. As Greg said, there's a lot of attention on, and has been a lot of attention devoted to the product market, including my attention. So it was very interesting to read this paper about monopsony in labor markets. Let me first have a brief summary of the paper. So monopsony power in the UK private sector labor market is the topic of this paper. In particular, they look at first at the evolution and second at the effect of wages. The authors use employee-employer data from the NES-ASHE, and also they use, which is a survey, and they also use a business registry data set for the other data on the firms. The labor market power proxy is their Findal index by industry or region and time. However, they also do some robustness check with occupation, region, and time. What they find is that dispersion in concentration between and within industry is pretty large. However, the within industry is not explained. So the skewness is not explained by the between region variation. In terms of methodology, their specification is based on a search and matching model by Pizarrides. They have a regression, panel regression with fixed effect in interactions. So in the baseline, very simply, let's start with the baseline. So we have wages regressed on their Findal index, and they have a lot of controls, Greg explained, also size, which controls for the natural relationship between size and concentration, and different fixed effects. Now, take this baseline and augment it according to the model with two interactions. The first one is with the collective bargaining agreements. So the unionization that Greg explained. And the second one is with the labor market, sorry, not labor market, but labor productivity at the firm level. The proxy is not first best because we would prefer to have a value added over hours. I'm not sure whether you can include these hours from the business statistics, but maybe could be interested, but it's a good proxy as a show. In terms of the results, I reproduce here, more than reproduce, I copy and paste the charts from their data sets. I like to see the charts because I think they give a better idea of the marginal effects. So on the left-hand side, we have the marginal effect of an increase in concentration on wages. As you can see, if employees are covered by the collective bargaining agreements, which is the blue line, we have a positive effect that is the decrease when the labor productivity of the firm increase. And this is reduced when it becomes practically all negative, so negative effect, when the employees are not covered by the CBA. On the right-hand side, what you see is the effect of an increase in labor productivity on wages, which is obviously positive, and decrease to the extent that the labor market becomes more concentrated. So I think this paper is very relevant because understanding the trend and the effect of monopsony, as also Greg said, help us to understand the trends that we are experiencing, such as wage stagnation, decreasing labor share, although here the literature is a bit more divided, there are contrasting evidence, and also would help to understand the influence that the concentration can have on introduction of minimum wage, because influence the worker reallocation. And finally, in terms of policy implication, well, this definitely can have big policy implication on antitrust law, not only on mergers, but on non-compete and non-poaching agreement. Silicon Valley is a clear example of non-poaching agreement situation on the employment regulation, and as the paper highlight on the collective bargaining agreement role in different, also for macroeconomic implication. The OECD Employment Outlook of last year have a good chapter on this discussion. My first more technical comments is about the concentration measure that the authors use. So they use the National Earnings Survey, which is I checked in the documentation because I didn't know it, never worked with this. So it's a weighted sample by age, sex, and occupation and region. However, not by firm size. So this can create a big potential bias that it's discussed in the paper. And the authors also run a Monte Carlo simulation exercise. In this exercise, the bias is a function of the true concentration and the sample size. And the outcome of this exercise is that for a moderate sample size, this bias is not relevant, it's not important. However, from the paper, it's not clear how good is your sample. So how this moderate is, because from my point of view, the sample is pretty small. Moreover, you drop firms with less than 10 employees, which, as you said, is just 2.5% of your sample, but this doesn't mean that it's such a little proportion in the population. I'm making an example. In Spain, with our business registry, we see that 64% of the firm have less than 5 employees. Obviously, UK is definitely not like Spain or Italy. The structure is completely different. But anyway, I think that your sample could be very biased towards larger firms. So that's why I would like to suggest, if possible, to use some weights which take into account the probability of observing each company given its size to correct for the overrepresentation of the firms. Another point on the Findall index is that most of the literature use this index is based on not occupation as dimension. And you say that you also, in the paper, you say that you need to run some robust check. So I would really suggest you to show it because it will be important. Then another point that is not on the paper, but you pick up in your presentation is that Schubert and co-authors show that workers' true labor market rarely coincide with the occupational boundaries, and they adjusted their Findall index to consider this outside option. And I think this outside option, it's very important. We should think a bit more about it, because considering, for instance, a chemist, which is specialized in radioactive materials, and then a cashier. So I think within a concentrated market, given the specialization, the chemist is much more tight and cannot substitute so much across work than a cashier. So in this case, the employer can exercise a much stronger labor market power. My second comment is about the relevant metric for labor market power. So you use a kind of a stock measure, and most probably, I would suggest that it would be better to use a flow measure because it captures much better a bargaining relationship. So for instance, Azar use a posted vacancies and application. And so not sure again that this is possible. You can do it maybe with a subset of another data set or something similar in order to have a robustness, for instance, or whether you have any reason to use a stock measure, and then maybe you can react to this afterwards. Another point is that other papers have shown that labor market power it's not fully captured by concentration. Or let's say there are two different things, in particular according to Hirschbein. And in fact, there are other frictional factors that can explain this, can lead to labor market power. For instance, information symmetry, transport costs, globalization. And so they look at a different metric, which is markdown elasticity of labor supply. So I'm not sure, again, you have all the data to look also at this dimension, but if you want to look at generally labor market power, maybe you should include also this kind of considerations. My third comment is on the positive effect that you find when you include productivity measures. So if we look at the bottom of the slides, it's a snapshot of your regression table. And as you can see, the last column is the one where you consider the productivity measure and interaction with productivity. I didn't report here the whole table. And the coefficient is positive. This positive effect is particularly clear, so it's for 50% of the firms in case employees are covered by CBA. But notice that this image is cut and practically start at 10th percentile. So anyway, for very low productive firms, you always have a positive effect when you increase concentration. So I was wondering whether you have an intuition for this. And I would like to suggest a positive potential intuition, or let me kind of think out of the box. And we looking at product market regulation and making a kind of parallel, or whether something could be going on there. So product market concentration has been increasing in the US. Many authors reported this. However, it has also been shown that it's not always bad. In some cases, actually, concentration allows for the rise of superstar firms. So firms need some kind of return on investment to be able to invest and become more productive. So this leads to increasing productivity, in particular from intangibles. Cruzet and Eberly also show that this effect is heterogeneous across industries. So we see an increased labor productivity for some industry, while for others just matters of markups. So my first question is like whether we could see an heterogeneous effect in labor market concentration across industry, or even better for me, across occupations. As I said before, this occupation idea, I think it could be better fit could be better capture some other friction or characteristic of the labor market. In the same vein, to explain this positive effect, maybe you could look at whether there's a nonlinear relationship, so a monotonic relationship. And this is come from the idea that, from finding that markups and investment have this monotonic relationship. And so assuming that there's a correlation between product market and labor market power, maybe it could be that low productive firm could use the additional profit margin to invest in human capital, attract higher productive workers, and offering a higher salary. So I don't have any evidence for this, it's just a potential story. And I would like to close with some additional comments. So the first one is about the collective bargain agreements. I think your paper goes very much in the unionization story, and I think it's very interesting. Well, I would suggest you to maybe take advantage of any variability that you have there. So we observe a decline in the role of the union in the participation. And so is this observed decline for all the industry occupation? There's some heterogeneity there that you can exploit to understand better the causal effect or what's going on. And also of the role, let's say. And a second point, which is from a different side, is Hirschbein and Macaluso find that highly concentrated labor markets tend to have greater demand for skilled rather than unskilled labor. So again, here, additional insight on concentration distribution by occupation could make you try to have a better idea of the mechanisms that are behind. Wage measure, this it's as I said, it's a minor comment. I'm not sure you can do something about it, but Bassier and co-authors find that if you want to capture these dynamic aspects in the same vein that we saw before in the previous slides, then wage variation generated by movers is a better measure than simply wage. And then small points, as robustness, I would use like productivity and non-contemporaneous, just to reduce simultaneity concern. An IV approach on concentration is always very welcome, also because the other papers and this literature use it. And I think you already, this one is one of your next steps. So good point. And I conclude. So thanks again. As I said, this is a very interesting paper. And I think it's. I look forward to see the model, because it's could have very interesting implications. Thanks.
Thank you so much for discussion, Gregory. Now you have time to answer to comments from the discussant. Would you like to address them?
Okay, can you hear me okay?
Yeah.
All right. Well, I mean, there was a lot there. So thank you very much indeed, Silvia, for taking such careful attention of the paper. And I don't disagree with anything that you've said. I think I'm going to try and basically, when the lockdown's lifted, the first thing I'm going to do is visit my mother. And the second thing I'm going to do is go straight to the Office of National Statistics and implement all the changes that we want to make, including, of course, your excellent suggestions. On the issue of instrumenting for changes in concentration, I think it's something we're going to have to do, but I am, I read this great paper by Alwyn Young, where he suggests that in many cases, the mean squared error of OLS parameter estimates is lower than that of IV estimates, because you end up with weak instruments and people misuse large sample results when they're using them. So we'll do the instrumental variable one for sure, but I'm not sure, given the strength of the instruments that we'll have available, whether we'll get closer to the truth with that. You're right that we showed lots of we've done more robustness tests than we show, so we should show those. And I think in particular what you suggested on flow measures of wages, or the wages of new joiners, we can do that because it's a panel, so we can measure transitions. But yeah, thanks very much, Silvia, indeed. And I can take some questions now from the audience.
So we have two questions so far. The first question is from Jose Garcia Lozao. Let me read it aloud. So, which is the level of collective agreements? Have you checked the robustness of results to use region sector fixed effects? These block fixed effects will allow you to identify changes in concentration only from time variation, as your current specification concentration changes arise both from time changes in cross-section and time series.
So to clarify, on the first one, the level of the collective agreements is, generally speaking, they're negotiated at the firm level rather than at the industry or national level, as in some other countries. So the wage bargaining is generally speaking decentralized to the firm level. On the question about robustness to using region sector fixed effects, we use region fixed effects and we use sector fixed effects and time and occupation. But I don't know if we actually I don't think we've tried using region sector fixed effects. Of course, every time you do that, you kill some more of the variation, but it may be necessary. I mean, we can certainly try that and we'll see what we get. So that's a great suggestion. Thank you. Next question.
And next question is from Yuri Gorodnichenko. So he's asking, what is measured by wages? Is it wage rates or earnings?
It is weekly earnings. So it will include overtime measure. Yeah.
Okay. Okay, and one more question from Hager Ben Romdane. He's asking have you applied the Hausman test to identify if the effects are random or fixed?
No, I don't think we have applied the Hausman test. So we can try that for sure.
Okay, so we still have time for questions, maybe from panelists, because we have 10 minutes for additional questions, if there are any. Okay, so there's a question from Michner. You can unmute now, right? Michner, you can talk now. We unmuted you.
Yeah. Hi.
Hi.
Hello.
Hi. I was wondering if there might be other benefits which are not measured by wage that could play a role. Of course, this is something that might be related to the way the contracts are set up and so on and so forth. And the second one was whether there might be some form of substitutability between labor and capital at the level of the firm that might give sort of an additional dimension across which the firm may negotiate. And I'm not sure this is related directly to the market power, but it might be something that confounds a little bit the effects.
So on the first one, the other benefits that tend to be offered in the UK labour market tend to be relatively small. So we have it's unlike the US where you have very large variation in health benefits. We could probably, I don't think we have data for that. What I think that will mean is we're mismeasuring the left-hand side variable and attenuating the significance, but not the point estimate of our parameters, unless I'm mistaken. Can you clarify a little bit on the capital labor substitutability point? Because I'm not sure I got it the first time, Michner.
Michner? Michner, can you clarify?
Yeah. Okay. Now I was not able to unmute. So what I was thinking that if, for example, the firm has an ability so let's suppose that there is an increase in demand or something like this, and there's no way that you can satisfy this without paying overtime. Then in that case, that shows up immediately in wages. But if you're a firm which has the ability to do that by employing more capital with the same labor in some way, so of course this might be very industry specific, then this might not necessarily translate into more wages. And this might be more related to the industry than so perhaps to the product market than to the nature of the product than necessarily to the concentration and the ability to squeeze something out.
So thanks very much. I think I understand. What one way we could potentially control for this would be to look at the capital labor ratio as an additional right-hand side variable. I think, if I've understood you correctly, that will be available for most but not all of the employees in our sample. But that's a great suggestion, so thank you, Michner.
We have one more question from David Berger. So he will ask this question himself. David, please.
Oh yeah, can you hear me?
Yeah.
Okay, very interesting stuff. So a couple questions. One is, how should I think about how do you think about the aggregate trends in concentration in your data set? And I guess more importantly, what do you think about what are the sources of our monopsony power here? Do you think of them more coming from sort of consumer preferences, or do you think about them coming from more, like in the United States, we think that non-competes potentially are a big deal, so coming from more like firm side or search frictions? Do you have any sense, or could your data shed any light on these sort of questions? Thanks.
So in terms of how to think about the aggregate trends, they will be driven by lots of they'll be driven by many of the technological and policy changes over such a long sample. So we've seen product market reforms, which will tend to make, maybe they'll have made the product market more atomized. And so you'll expect to have more atomized labor markets, but that doesn't necessarily follow. I mean, I think the big takeaway I have from the stylized facts in the data is that there isn't much of a trend in monopsony measured by the HHI over time, and it's certainly tiny compared to the cross section across industries. So most of what matters for you is the industry that you work in, not really the time period. So and that pushes me towards technology as the source of concentration, and then possibly also the source of market power in the labor market. Does that answer your question, David?
David?
Yes, thank you. Thank you. Yes, great.
Okay, we have one more question from Yuri Gorodnichenko. He's asking, is there any difference in cyclical behavior of wages over the business cycle for different concentrations?
We could certainly check that. I guess you would, because most of the variation is at the industry level, you might be worried whether you were just picking up some other source of industry variation, like demand being more cyclical. I guess you could try and measure demand at the industry level as well, or product market concentration. But that would be a nice thing for us to check, which we can certainly go and do. So that's a nice suggestion. Thank you, Yuri.
And there is one question from Olga Klishchuk. She's asking, in your graph 2, in your paper, Abel 2018, the programming industry has demonstrated high level of concentration. And thus, doesn't remuneration in this industry really depend on level of market power of employer?
So which industry?
Programming industry.
And sorry, I don't quite understand the question. Could you repeat the question?
Okay. So in your graph 2, in paper Abel et al. 2018, the programming industry has demonstrated high level of concentration. Okay, that's a statement. Then the question, does the remuneration in the industry really depend on level of market power of the employer?
Do you mean the level of market power of the employer in the product market or in the labor market?
Olga, can you clarify?
So I could
just guess. Yeah, I don't know.
Okay, let me guess. So I can't really make a statement about any individual industry. What I can say is that, as far as we can tell, remuneration does depend on concentration in the labor market. Part of what we find, and what I think is where I want to head next with the paper, is that it's the amount of power that the worker has in the labor market that determines how much of the extra productive capacity of the firm that the worker captures, so or the extra revenues. So I would say that if the product market is concentrated, then the firm may be earning rents, and if the labor market is also concentrated, then unless the worker is somehow protected by a union, the firm will be disinclined to share those rents in the form of high wages with the employee. So that's the best I can do in answering your question.
Okay, thank you. So please, any additional questions? We have still time, maybe for 1 or 2 short questions. 3 minutes remaining. Okay, if nobody asks, then of course it's kind of obvious question. How will your results be affected by the quarantine and epidemics? What do you think? What will happen with concentration and unionization?
Yeah. So I mean, what I expect to see is lots of insolvencies, and then lots of destroyed job matches, high unemployment, and so I would expect to see the firms that survive over the next few months, as and when demand comes back, that they will have the upper hand, because there will be fewer of them, and there will be large queues of unemployed people. So I would expect them to be able to exercise more power.
Okay, great you all for this fantastic discussion. Thank you all. So we can start the second presentation, second paper. So the second paper is Migration, Long Run Fiscal Sustainability and Economic Unions. So it's presented by Sergei Kiyashko from National Bank of Ukraine. And your discussant will be Karl Valentin from Sveriges Riksbank. So we have 20 minutes for the speaker, 15 minutes for the discussant, and then 15 minutes for general discussion. So please, good luck. The floor is yours.
Thank you very much, Maxim. I hope you can hear me. You can see my screen and me. Okay, so it's great pleasure to present this project. It is a joint project with Pavel Kopets from Narodowy Bank Polski. As we are both representatives of central banks, the usual disclaimer applies. And what we do in this project, we try to understand what is the interplay between migration and the long-run fiscal sustainability in economic unions. Is migration a desirable feature in currency unions? One argument in favor of high labor mobility was presented by Mango. The idea is that the negative country-specific shocks would be observed if unemployed people migrate to other parts of the union. This means that migration can compensate for the absence of local monetary authorities, which would mitigate those shocks if currency union was not established. However, in the long run, nominal rigidities become irrelevant, and currency union becomes similar to economic union. And it is less clear whether the desirability of migration remains in the long run. Importantly, high labor mobility challenges social security system and fiscal sustainability in sending countries. As workers move to another country, their debt per capita increases. Also, it gives rise to the old age dependency ratio, so that it becomes harder to finance pensions and social security programs. Moreover, as labor outflows, the marginal productivity of capital decreases, which also may lead to outflow of capital, further decreasing the output of sending economy, and further increasing the damaging role of migration. So overall migration seems like a great challenge, especially for low productive countries. And in this paper, we seek to understand how labor mobility shapes the optimal fiscal policy. For example, we want to understand how low productive economies who suffer from labor outflows should design their fiscal policy. Should they set higher tax rates to compensate for the erosion of labor income tax base, or maybe they should actually conduct policies which would increase the well-being of workers in order to attract them and keep them in this country. Also, we want to understand how migration affects the performance of the whole economic union. For example, we want to see how the fiscal conditions in low productive and high productive economies change. Do we observe higher frequency of defaults because of migration? And for example, whether migration is welfare improving or not. Our framework is the closest to the model by Sons, Torres-Letton, and Zilipoti. We develop a model with continuum of countries. Each country has two overlapping generations, young agents and old agents, who enjoy consuming private goods and public goods, and old agents enjoy public goods more than young agents. There are two factors of productions, capital and labor. And also there is a government who conducts time-consistent fiscal policy. We introduce three extensions to the model. First, we allow for cross-country labor mobility. There are some frictions which we discuss later. Second, we add country-level productivity shocks in order to create incentives for people to move from less productive countries to more productive countries. And finally, to analyze fiscal sustainability, we allow governments to renegotiate over their debt. Let me go to some details of the model. By N0, we define the number of all agents and the beginning of the period. Then the timing is the following. then every old agent delivers one young agent. When the new generation of agent is born, there is survival rate which hits old agents. And the assumption in our model is that only young agents can migrate to other destinations. Importantly, when we say migration, we mean permanent migration and not temporary short-term trip to other countries. So it's rather once and all decision. For this reason, we are not going to discuss remittances. The welfare of agents depends on private consumption today and private consumption in the next period, and it also depends on public spendings. Importantly, we assume that only older generation enjoys public spending, so we treat public spending in some kind of pensions or social security benefits. When young agents can work, earn wage W, and the only decision they make is basically to split the after-tax income between consumption and savings, which are then consumed in the next period. Okay, so let's discuss the migration. The migration process in our model consists of two stages. The first stage is assignment. We assume that every agent draws a country with welfare corresponding to a lifetime consumption C hat from the distribution of countries. Also, because we think that people are usually looking for more richer destinations, we apply function phi, which increases the probability of drawing a richer country. Once there is a migration opportunity, the next stage is to decide whether to migrate or not. In reality, this decision depends on many idiosyncratic factors like migration costs, family ties, etc. To abstract of those, we model migration decision as a simple exogenous stochastic process with probability of a decision to migrate being positive in the difference between welfare of destination country and welfare of original country. In other words, if there is, if a person draws a richer country, there is a higher chance that person chooses to migrate. Another important notice is that we also allow people to move to less prosperous countries, less productive countries, because we do observe this feature in the data as well. So then the total number of young agents in the economy also depends on number of emigrants and number of immigrants. For tractability, we then compute the gross migration rate at the ratio between total number of young agents and the number of old agents in the beginning of the period, or the number of young agents before migration takes place. If this coefficient is greater than 1, it means that country experiences labor inflows and vice versa. So let me talk about production. We denote by Y country level productivity, which follows AIR1 process. Then another important assumption is that productivity depends on debt renegotiation decision made by the government. So if the government decides to default on part of its debt, there is cost to productivity, so that the aggregate productivity then depends on this debt renegotiation decision, and it is decreasing in the portion of debt under default. Then the output is produced by competitive firm, which maximizes standard productivity function. It uses Cobb-Douglas to produce and hires capital and labor. Capital is assumed to be perfectly mobile between borders and to depreciate at a rate of 100%, because one period in our model corresponds to approximately 30 years in reality. However, the labor is not mobile across borders. Once all the migration decisions are made by agents, no further labor inflows or outflows are allowed. Because of this friction, there is variability in country level wage, between countries, and in the end of the day, wage depends on the productivity level and also on the debt renegotiation decision made by the government. So going to the government problem, it makes 4 decisions. It makes a decision regarding taxation, public spending, debt issuances, and debt renegotiation. And it increases the aggregate welfare, which consists of welfare of young agents, UY, welfare of all agents, UO, and alphas are Pareto weights, which in equilibrium correspond to the population sizes. Whenever applicable, we define everything in per capita term. Particularly by G, we denote public spending per agent, and by B prime, we denote future debt per old worker today, and then prime denotes the future. Then the welfare of young agents depends on consumption today, consumption tomorrow, which is a function of taxes and wages, and also public spending, but public spending tomorrow. It is not chosen by this government, it is chosen by the next government, and this government can only affect it by choosing state variables. And welfare of old agents depends on their past savings, which are not affected by this government, and the decision of the government to spend on public. The optimal fiscal policy must satisfy the budget constraint. The left-hand side represents the expenditure side, which consists of public spending and outstanding debt. And the right-hand side is the revenue side with tax revenues and proceeds from issuing new debt. How migration affects this problem? It mostly affects the problem through the revenue side of the budget constraint. So once we have inflow of new workers, we have an expansion of tax revenues, and we also can decrease that level per worker once we have a larger amount of workers. Importantly, when government designs its fiscal policy, it takes into account how an improvement in welfare of young agents affect the migration. Then we also have competitive financial intermediaries in this model, which trade all types of assets. We assume that they are risk neutral and they have access to external borrowing and can borrow at exogenous interest rate R. So they do all the pricing of the money. Because we are interested in time-consistent fiscal policy, we consider in stationary market perfect competitive equilibrium. Due to lack of time, I skip all the details, which are quite standard, and then just that. Okay, so how does migration shapes the optimal fiscal policy in our model? There are 2 main channels. The first channel is the redistribution from old to young agents. The idea is that governments in our model, in the presence of migration, have strong incentive to compete for labor force to improve their fiscal conditions. And there are 2 ways the government can attract migrants to its country. There are two trade-offs. The first one is to redistribute resources from public spending to private consumption. So if we consider this trade-off in economy with no migration, then the government would choose government spending to be proportional to private consumption. However, in the world with migration, the government also takes into account how this redistribution brings new migrants to economy and improves and has fiscal benefits for this economy because it expands labor income tax base and also decreases debt burden. And in the similar way, the government can redistribute resources from public spending today to public spending tomorrow because young agents will enjoy those public spending mostly tomorrow. The only way the government can do it, given that it is time-consistent fiscal policy and government makes only today's decision, is by decreasing the level of debt. The second channel, how migration affects fiscal decisions, is through the optimal debt renegotiation. Generally, when government decides to default or not and on which part of debt to default, it takes into account marginal benefit of default, and which is saved resources from default, and marginal cost of default, which are losses, cost to productivity, which decrease tax revenues and disposable income and private consumption. This implies that countries with higher productivity usually have higher cost of default, so they default less frequently. If we add migration to the model, it makes it even less costly to default for sending countries, for low productive countries, and even more costly to default for receiving countries. So in order to understand how quantitatively important those channels are, we do a number of numerical simulations. We calibrate our model to match some features of the European Union, like country-level productivity process, some fiscal conditions of European Union, and intra-European Union migrations. Important to note that our one period in our model corresponds to 30 years, so some of the parameters I adjusted to take it into account. So let me go to the results. This is the first panel, which shows the optimal policies of countries as a function of state variables. One state variable is debt per old worker. It is depicted on x-axis. And the other state variable is productivity level. We denote by thin and dark lines country policy of countries with low productivity, and by thick and lighter lines we present high productivity economies. Then by green lines, for example, here we present economies in a world with migration, and red lines correspond to policies of a world where borders are closed. The first panel corresponds to debt renegotiation policy, which also the long-term spreads. So we see that less productive economies choose higher default more frequently and have higher spreads than high productive economies. And migration, the green lines, actually amplifies those differences. Then this is the optimal provision of public goods. We see that more productive countries expectedly have higher provision of public goods. But what is the effect of migration? For every country, the migration makes economies to be more prudent and to spend less on public goods. This is true for both low productivity countries and high productivity countries. A very important result is on debt issuance. We see quite huge difference between debt issuance of economies with migration, green lines, and without migration. The reason is that economies try to compete for labor force and improve welfare of young agents. To do it, they have to be prudent, and they have to have lower debt issuances so that public goods provision in the future can be higher. As for the tax rates, it's the same idea, trying to increase private consumption of young agents. Medium productive countries and high productive countries, they tend to decrease interest rate. However, low productive countries cannot afford to decrease tax rates. They actually increase tax rate because they have to compensate for the damaging role of migration on labor income tax rates. Importantly, these figures just show the differences in fiscal policies in the world with and without migration, keeping that level as constant for all those countries. However, if we want to understand the performance of the whole union in equilibrium, we have to take into account that debt distributions in these two worlds with migration and without migrations can be very different. So we move to discussion of those distributions, and looking on the debt to GDP, we see that it changes quite dramatically. Again, the green line corresponds to the distribution of debt to GDP in the case migration is allowed, and the average debt to GDP is calibrated to be 71%, which is the level of the average debt to GDP in European Union in data we use. And if the borders were closed and in equilibrium, the average debt to GDP increases to approximately 89%. So this change is actually very huge, and it drives many other results. For example, if you look at spreads, it also declines. So without this result, we would expect that low productive countries would default more frequently. So the distribution of spreads would be more flatter, and maybe even shifted to the right a little bit, but it shifted to the left. Then similar picture with tax rates. We have some of the low productive economies which probably set a bit higher tax rates, but most of the economies set lower. Yeah, and public goods and private consumption are in line with what we discussed on the previous slide. So let me go to the final set of results which concerns the welfare. We do the welfare analysis. We try to understand who benefits and who loses from migration. We do the welfare analysis for agents in different countries with different levels of productivity, and we do it separately for migrants and for stayers. Let me quickly start with migrants. Clearly, they benefit because on average they move to a better country, and if you move from really poor country, it is a high chance that you get to a really rich country, so that you have high welfare. Regarding the stayers, we have that rich country win, which makes perfect sense. They have labor influence. But the surprising result is regarding low productive economies. Our prior idea was that probably at least the least productive economies who suffer from labor outflow the most, they would lose from migration. But actually, we see that there is some very minor benefit. And if we think about it, what is the reason? The reason is that the private consumption increases. Why the private consumption increases? So if we do the decomposition of private consumption, if keeping that level as constant, the governments would set higher tax and it would default more, so the private consumption would decrease. But because the average level of debt decreases dramatically, it actually makes it to be reverted. And in the long run, despite the fact that migration has damaging role for low productive economies, because governments conduct very prudent fiscal policies, they actually, at the end of the day, benefit from migration. That's it. Thank you very much for this opportunity to present the paper.
Okay, thank you, Serhiy. Please stop sharing the screen. Now it's time for your discussant, Karl Valentin, and you will have 15 minutes for discussion. And then, Serhiy, you will have opportunity to answer suggestions. Please, Karl, the floor is yours.
Yeah. Okay, thanks a lot. Give me 1 second. Can you hear me?
No, not very well.
Okay. That's bad. Okay. Do you see my slides?
Yeah, we do see your slides, right?
Yeah. This is some quality that we will have. So address again in the next conference overall. So to summarize the paper, it analyzes the relevant and understanded question, the fiscal sustainability of countries in a world of international mobility, where people can move. More generally, it explores the macroeconomic and fiscal consequences of economic migration for heterogeneous countries. And it turns out that the fiscal challenge is young people leaving a country. So in that sense, qualitatively, the paper captured the same or similar positive fiscal effect on host countries as on the paper. And it's a long-run analysis, steady state. So let me talk about the outline of the framework used and exercise performed. So the model is a model of the economic union, let's say the EU, with approximately free mobility of labor. Countries differ in two dimensions in terms of the productivity and the government. And there are young and old households, two representative agents. Young are the guys that can move around internationally, and there will be tendencies for them to move to opportunity, to move to richer countries where they will receive higher consumption.
Carl, sorry to interrupt. We cannot hear you well. We cannot hear. Sorry, but yeah, we can't.
Yeah. What should I do? So is there any way you hear me?
Maybe you can bring a microphone closer, I guess. If you try microphone, maybe it's a because there's a real noise. You can see the slides, but we cannot hear well.
Please repeat that. I couldn't catch it. Yeah, so you so yeah. Does this make a difference? Do you hear me now? I don't really have a backup.
Okay. Carl, there are a couple of options. Can you try to turn off the video? Maybe it's internet, and then maybe it will be better. So just turn off the camera. Yeah, maybe it's internet.
Yeah, okay.
Thank you.
So I stopped sharing the video. We hope that helps.
Yes, I think it's slightly better.
Yeah, that's smart. Sorry. Okay. I hope that you can hear me a little bit now.
Yeah.
So I'll continue the presentation, and you can tell me if I should do something else. Yeah, sorry about the summary to all of you. Again, very rough summary of the paper. You saw that slide. The framework is this. So young people are the mobile ones. They can when they leave a country that hurts the country fiscally. because there's fewer people left in the old country to pay off the existing debt, there's a lower fraction of young per old. And the exercise performed throughout is to compare a situation with and without labor mobility. So a little bit more detail about the model. There's 2 representative agents, young and old, in each country. And importantly, all young agents are identical. You know, so you get the productivity of the country where you live, so to say. So if I move to a more productive country, I become more productive. There's benevolent government that choose policy to maximize the weighted utility of the 2 agents, and the policy instruments are 2: tax rate and the government spending. And my interpretation, the government spending is only valued by old agents. And in my interpretation, these are not transfers because they enter utilities separately from private consumption. So there doesn't seem to be money transferred to old people, more some form of public good that old people value. There's no capital taxation, only labor income can be taxed. And agents can move subject to some costs. And from a technical point of view, it's an extension of the model by Song, Storesletten, and Siljeborg. Let's switch. So here's some interesting data used. So basically on the x-axis, we see the consumption per capita in all EU countries. On the y-axis, we have the share of net migrants, percent of total population. The green dots are the empirical, the data points. You got the, Germany in the top right corner. And I think the idea is that we should note that there's like a weak but still a positive relationship between consumption per capita and share net migrants. So that a model where people move to richer countries can do a good job. And then the red dots are the model values, what the model can do in terms of this. And that's it. I mean, so in principle, so what the authors do is they use the data here to choose 3 parameters to fit to minimize the distance here between data and model in the dimensions of the figure. So for me, the main finding of the paper is that migration disciplines fiscal policy. It's a nice finding. And the intuition is that government must make policy attractive for the young, as they are the mobile agents. How do you become an attractive country for internationally mobile workers? Well, you reduce government expenditures and taxes. For taxes, it's kind of obvious. You lower the labor income tax, it becomes what else equal better country to live in. Reducing government expenditure is positive in the sense that it reduces debt, so that as the agents will, in 30 years retire, it's a better country to live in, because you remember the move is a permanent move. So in the figure in the panel, to the first panel, government spending, there's 3 lines. The solid lines is the outcome, the optimal fiscal policy in the model when migration is allowed. And we notice that the solid lines in this panel, all 3 of them, are below the dashed lines, where the dashed lines represent a world without migration. So the fact that people can move between countries reduces government spending. And here maybe I should point out that the red color indicates the high productivity country, the brown color middle productive country, and black color the lowest productive country. So anyway, we get a very clear result there on government spending. things are a little bit more complicated for the tax rates to the far right, the third panel here. But focusing on the red color, we see that moving from a country from a setup without migration, the dashed light red line. Here, tax rates are lower when we have migration. And the reasons are twofold, but mainly these highly productive countries, they benefit from migration and can reduce taxes substantially, 1%. Sergey already went over the figure with the welfare, and we just note here that the welfare of all young agents actually increase when mobility, with international mobility, and that's a somewhat surprising result, but he explained it well. Over to my comments. I have 6 comments. So where is the economic union? That's my first question. Are all workers the same? A little bit of quibbles about the measurement of migration. Question about the elasticity of migration. And a suggestion for an extension where you can temporarily move to a country for less than 30 years. And then a microdata perspective. So let's take them in order. So I don't understand how this is a model of an economic union. There's no role for union-wide policy. There's no trade or dependency between countries other than migration. And there's no coordination at all between countries or possibly restrictions on say minimum tax levels or maximum tax levels. So to me, it is a union in the sense of a free labor movement, but I don't see the other aspects that we normally think of. So for example, the European Union. One might also ask if all workers are the same, so in the model, as we just talked about, all young agents benefit from international mobility. But my question is whether this result could be reversed by heterogeneity among workers. So what I worry about is the most productive workers leaving a country, maybe a poor country with high debt. And that seems plausible if labor tax is proportional or progressive, and some country is highly indebted. Then it seems like a good, the payoff of leaving that country is highest for the guys who expect their labor income to be high. And I worry that this might be generate poverty traps or some countries left behind. So that's a clear question to the authors. Regarding the measurement of migration, so the current calibration of the paper uses 1 year, year 2017, Eurostat data for net migration. But my claim would be that migration is a volatile variable, and my suggestion is to use a mean of over a decade or so to capture structural factors. And I put a little figure here of 5 of the countries used in the paper, the migration rates per year. And my basic statement is that these lines cross each other sometimes, which means that kind of matters what year you use for the calibration if you use a single year. So I think it's a good idea to take a mean over a slightly longer period to get rid of the noise or the volatility in these things. I would like to learn more about the elasticity of migration. And so to me, superficially, this elasticity of migration to changes in tax rates appears excessive. But I might be wrong. But anyway, it would be nice if the authors in the quantitative section report the elasticity of net migration to taxes and report the elasticity with respect to country productivity. One thing one could do is complicate the modeling of international mobility a little bit by using some kind of gravity-style model. So the cost of moving might be lower if I move to a neighboring country or a country that shares a language. All these things that the trade guys worked on for a long time. Finally, one question is, where did everyone go? So comparing the coming back to this picture of net migration. So in the model, the red dots, they have a very strong tendency to be below the x-axis. So there seems to be lots of, basically only countries that people leave, but there is no country they go to. There's something I don't understand there in the model implications. For the empirical values, I see there's large countries that people move to, like Germany and Great Britain. But in the model results, I don't see where people move. Finally, a somewhat obvious suggestion for an extension where you allow for temporary mobility. And the idea there is to allow people to move somewhere for less than their entire life. For example, I might move for only 10, 20, or 30 years to a different EU country and then come back to my home country or original country before retirement. And my conjecture, somewhat loosely, is that separation of this choice where to live when you're old and when you're young might reduce the fiscal discipline for migration. And the reason is that I guess that reducing government spending and debt does not affect the attractiveness of the temporary living in a country as a young. So if I move to Ireland for 10 years, I don't care whether Ireland racks up debt that they have to pay off in the future and provide lower public goods in the future, because I'll be back in Sweden when that happens. Okay, finally, some microdata perspectives from Sweden. So where I would like to question here is if all workers are the same. So this is not proof of anything, but just indicative evidence from a small and somewhat special country, Sweden. So in Sweden, it seems like there are substantial labor market differences between people depending on their country of origin. So there's estimate by Andreas Ek at LSE that non-natives are only 73% as productive as natives. So these are estimates. They might be uncertain or even incorrect. But still, there's a hint that productivity differs between workers from different countries.
Sorry, Carl, we need to move on because there are only 8 minutes remaining. So can you wrap up your comments, please? Just a few seconds.
Absolutely. 30 seconds should be enough. Okay. But for sure, we know that employment rates differ between people from different countries. That's what's illustrated on the graph here to the right. Natives are the green line. They have higher employment rates than and together with Conny Olofsson and Andreas Westermark, I explore these kind of things in a separate. So let me conclude. This is a nice paper on an important understudied topic. It obtains clean analytical results that I skipped over in this discussion. The main novel result is that immigration is a disciplining device for governments. Thanks a lot. Sorry for the sound trouble.
Thank you, Carl. Sergey, you have now time to address these comments by the discussant. And please leave a few minutes for general questions from the audience.
Sure. Can you hear me?
Sure. Can you hear me? Yeah.
Yes. So okay. So now I do not see any echo. Thank you very much, Carl, for all your comments. And indeed, we probably have a little bit of work to be done to check everything. So I will address some of the concerns, maybe because we do not have much time. So regarding heterogeneity of agents, it's actually a very good point. And we started to think about it, but so far we stopped here because it requires, so this problem is quite intensive in terms of computational techniques we need to apply to solve for everything. So we think it might be a separate project maybe in the future. So how would heterogeneity revert the results? I do not really think that it would revert the results. It might actually make migration even more damaging for low productive countries, because if high productive agents from low productive countries move to other destinations, then the damaging role of migration would be even higher. And can it make stayers in low productive countries a bit less happy? Yes, for sure. But maybe fiscal response by the government will be even stronger in this sense. So like the idea of welfare improvement comes from fiscal response by the government, and the government might respond even stronger in this case. Regarding high productive economies, yes, so because high productive agents move to those economies, they might add some equality to the market, because locals will receive less like lower wages maybe because of competition with with foreigners. But again, I think that the overall effect will dominate. The positive effect will dominate. Regarding the comments with the chart, indeed it looks like the net thing is negative, but we double checked and it's actually zero. But we will think about how to present it in a nicer way. Maybe those green dots are just too high, like the data is not going to zero. The idea is that those markets from the left side of the picture, they are small, and the markets from the right side of the picture, they are large. Finally, very good idea about temporary mobility. So we indeed focus on permanent mobility to be able to discuss this redistribution between young and old. Temporary mobility probably do not have this, this trade-off which government would face. So this is an interesting extension, of course, but my very intuition is that it won't affect anything significant. But anyway, thank you so much for this discussion. It's very useful.
Great, thank you. So we have one question from Yuri Gorodnichenko. So he thinks that the paper is related to loan literature and fiscal federalism, and the literature emphasized that people can vote with their feet, in quotes. He was wondering if the paper can make a connection to this giant literature.
Yeah, can you read it one more time, please?
Okay. So the paper is related to loan literature and fiscal federalism. Literature emphasized that people can vote with their feet. So Gorodnichenko is wondering if the paper can make a connection to that giant literature.
I think yes. So far, we have been thinking about adding some kind of political mechanism to this model, so that when we have higher fraction of old agents, they have higher voting power, so that policies designed by government are more towards elder people. So I think we can move in this direction, but we have to think more carefully about it. And thank you for the suggestion.
And there is a question from Alexei Krevtsov, who is asking if you can please discuss the effects of relaxing perfect commitment by future governments.
The effects of relaxing perfect commitment. So there is no commitment in this. So we consider. Maybe I do not understand the question, but we consider mark of competitive equilibrium. So policy is time consistent. Every period the government makes a decision as a function of state variables, and there is no commitment. Again, we will think about as one period corresponds to 30 years. So it makes no sense to think about that government can commit to 60 years from now. But maybe I'm just I don't understand the question.
Okay, so are there any other questions from the audience, from the panelists? Okay, I think there are no more questions. So thank you all for a very nice discussion. Thank you, Sergey, for the paper.
Thank you.
Thank you, Carl, for the discussion. I think it's time for our next keynote lecture by Stefan Ingves from Sveriges Riksbank. And thank you all for participation.
Nu ska vi se hur de
Hello, that's Dmitros Sologub speaking. Now, as just Maxim said, there is a time for our keynote lecture today. Yesterday, we had a chance to listen to Professor Hall talking about re-employment, the process of re-employment after the crisis. And today, we're actually turning to the other side of economic profession, to the practitioner, to the central bank governor. And I think that's would be a very relevant question today from the person who has a very vast experience in the central banking and dealing with the crisis before in his native country and around the world. Therefore, I'm very pleased to have with me here, though virtually, Dr. Stefan Ingves, the governor of Sveriges Riksbank. Mr. Ingves has a very distinguished career, being already governor for almost 14 years, or more than 14 years. And apart from that, working before in IMF and have been also very active in the global economic and financial organizations like Basel Committee on Banking Supervision, European Systemic Risk Board, and so on. So indeed, I think the topic of the conference and the challenges for the central banks in dealing with the labor market and the current crisis, I mean, could not be more relevant than that. Therefore, without any further delay, I just give a floor to Professor Ingves for his speech, and then it will be followed by Q&A. Thank you, Stefan. Yeah, please go ahead.
Well, first of all, thank you for giving me the opportunity to speak. My topic today is labor market and monetary policy, and that's actually, when it comes to what I'm usually talking about, a highly unusual combination, because when you talk about monetary policy, normally you more or less take the labor market for granted in one form or the other. So with that as a starting point, let me stress that not very often that I've talked about monetary policy from this particular angle. But despite that, let's hope that I, in some way, in one way or the other, can do this topic some justice. And I'm going to talk about labor market aspects of central banking and other aspects of what's going on in any economy from two perspectives. The first one is really from the perspective of what is going on today. And then that is, of course, means that focus is on the pandemic and what the pandemic does to the economic developments in a small, very, very open economy like Sweden. And then the second part of my lecture will basically deal with long-term trends when it comes to the labor market and structural change. And I will use the Swedish economy as one example when it comes to how structural change comes about, what it has meant, and where we are today, and also where we came from. So there actually the time perspective could be 50 years or maybe 100 years. But I will start out talking about things in the very, very, very near future when it comes to this. So this is what I will talk about. Most of it is not really actually monetary policy in one form or the other. It's monetary policy, but attached to what's going on in the labor market in one form or the other. Presently, which is obvious to many, is that the world is going through a synchronized crisis. I'm talking about this not from an economic perspective, not all sorts of other perspectives, which are also, of course, also highly relevant. It's obvious that if you impose all sorts of restrictions in different corners of the world when it comes to people's possibilities to move around or to produce things, then the global coronavirus has brought the global economy to a halt. And that's just where we are, like it or not. And for most of us economists, this is an event which is highly unusual. If you talk to older people who are really old, they are aware of and know about all sorts of pandemics and other issues from a distant past. But from this perspective, essentially, in most parts of the world, the times have been pretty good for quite quite a while, and we're not really from the beginning trained to think about economic matters with this as a background. First of all, when it comes to the economic developments, when it comes to the restrictions will of course keep economies from moving on, and at the same time, when it comes to the debate going on in many countries, when to lift the restrictions and the uncertainty that will be lingering after the restrictions have been lifted, all those issues, of course, affect growth in one form or the other. This time, which is quite different compared to many other times in the past, is that now economies are affected both on the production side and on the demand side. So everything is more or less coming to a standstill at the same time. And as a consequence of that, if the global economy is shutting down more or less, then global trade will be affected, and that will affect all of us in one form or the other. Talking about this from my local perspective, and when we ask firms about what is going on here and to what extent they have access to credit, then if you look at these two graphs, the red graph and the blue graph, large companies and small and medium-sized companies, basically the picture that emerges when you ask particularly small and medium-sized companies, what about financing conditions? Clearly, you can see that the world has changed, and the world has changed dramatically in a very, very short time period. And this, of course, affects everybody. And given that the graph looks like this has, of course, also led to a very, very lively discussion domestically about what's going on in the financial sector and how do we deal with this. Now, given the openness of the Swedish economy, given that we have completely free capital flows, given that we have had completely free capital flows by now for quite some time, and given the size of our financial sector, and given our financial sector's dependence on funding from abroad, this has led to, at the global level, to substantial market turmoil. And of course, we imported almost immediately the turmoil, and the cost of funding went up, and there was a high risk that the cost of funding would go up a lot. And then, of course, substantial credit tightening would have worsened the crisis substantially. One of the differences this time, and particularly with my background, since I have dealt with financial crisis in different corners of the world many, many times, is that this time around, the whole thing actually did not start in the financial sector. So there's high value in itself trying to make sure that what's going on in the real economy is not also moving into the financial sector. So on top of all the other difficulties that we have to deal with, we would also end up with a financial crisis. Starting with the macro picture, and this is, I think you would find almost identical graphs in a fairly large number of countries. On the left-hand side here, you can see the level of GDP going back to 2006. And the red dotted line shows our projection from February. And then the two blue lines, A and B, are two scenarios that we had in our monetary policy report in late April. Now, if you look at these graphs, you can see clearly that what happens in terms of production and GDP is that we're taking a hit, and we will be taking a substantial hit. The only remaining issue is how deep is this thing going to go. And then the mirror of this is, of course, if you look at the labor market, because presently times have been good. Times have been good actually for a number of years by now. Unemployment has been hovering around 6%, a little bit higher lately, and we expected unemployment to stay fairly close to 7%, which is not really that far from our long-run structural average unemployment. But if you look at the blue graphs, you can see clearly we expect unemployment to peak anywhere between 8 and let's say 11 or 11 plus something percent, all depending on if things normalize rapidly or if it takes a long time for these things to happen. When it comes to the latest unemployment numbers that we have, unemployment is right now around 8%, 8.1, 8.2, something like that. So from that perspective, this is a very rapid and a very dramatic change. Now, thinking about these numbers and thinking about these graphs and projections from a central bank perspective, and given that in our environment the policy rate is already set at 0, then that of course raises the issue what to do. And here comes a list and an illustration of the various things that we have done so far. Essentially, what we try to achieve presently is to make sure that there are enough Swedish kronor in the system in such a way that there is pressure down on interest rates in all markets, because that will keep the cost of funding down for corporates, and it will keep the cost of funding down also for the household sector. And it is important for us presently to make sure that there is good access to credit, because if it were to be the other way around, then essentially we would end up with many bankruptcies. We will end up with many bankruptcies anyway. But by flooding the market with cheap funding, that will reduce the number of bankruptcies. So starting on the left side, we have created a funding for lending scheme where banks can borrow from us and pass the money on to the corporate sector in different shapes and forms. We have started buying government debt. We buy municipal debt, and we buy mortgage-backed securities, and we also buy different types of corporate paper. And this, of course, makes sure that these markets continue functioning. And we had an episode actually a couple of months back where particularly the corporate bond market almost came to a standstill. And I think that now things have improved, and that's a good thing in itself. Then we are also providing the banks with an unlimited access to loans from the central bank. This is full allotment, a little bit similar to what the ECB is doing. And then we have the privilege of having a $60 billion US dollar swap arrangement with the Federal Reserve. Now, given what is going on presently, this is what we have done, and this is what we can do. This is what we as an institution have been designed to do and contribute. But that does not mean that we can fix every imaginable problem. So here, what is very important under the present circumstances is to make sure that many policies actually work together in the same direction. And then, of course, what comes to mind in the first place is fiscal policy, because fiscal policy can be directed with precision to the corporate sector and to the household sector in such a way that you keep aggregate demand going, given all the difficulties that we have in the economy presently. Then, as an addition to that, monetary policy eases access to credit in the economy as a whole, and all the various measures that I just mentioned, all of them are actually pulling in the same direction, making plenty of Swedish kronor available to the corporates and the household sector. And in addition to that, the Financial Supervisory Agency and the National Debt Office have also produced a number of measures that basically improve banks' ability to provide loans in one form or the other. And we have also clearly stated that we're ready to do more if and when that were to be needed. But the brunt of this actually falls on fiscal policy. And here, of course, there are enormous differences between countries, because we happen to be in a situation where we have very ample fiscal space, because government debt to GDP is very low compared to many other countries in an EU context. So we have some degrees of freedom there, which is not the case in a number of other countries. But that does not mean that fiscal policy and monetary policy can 100% compensate for what is going on presently in the Swedish economy, we are certainly going to take a hit, and there's no question about that. The real issue is how to get out of where we have ended up as quickly as possible and with as little damage to the real economy as possible. Now, let me show to you some labor market effects of the pandemic and what is going on and what has been going on recently. And I hope that that will give you a bit of a flavor of what's going on in our type of economy and why this is very, very different compared to what we have seen in the past. This is one way of illustrating where we are. This is a graph showing redundancy notices that you get from the corporate sector. If you look at 2008, 9, 10, then you can see a sharp spike. And then on the right-hand side, you compare that spike, which was considered to be pretty serious back then, with what is going on presently, and everything has basically, in one form or the other, doubled. And that means that we have many redundancy notices, which will lead to very substantial layoffs. And that's why, of course, when I mentioned the unemployment projections, unemployment is likely to end up somewhere between, let's say, 8 to 11%. Same thing you can see if you look at the dark blue line, which is shows applicants for unemployment benefits. And here, if you compare 2020, 2019, and 2018, you can see that on those applicants are the numbers are really up compared to the other two years that I have shown here. And you can also see if you look at the dark blue graph that it's way above what we have experienced in the early 2000s so far. Another interesting, maybe sort of micro type observation is that we also see changes in job seeking behavior. Very new research when it comes to how job seekers behave have shown that fewer vacancies have been posted, and job seeking has decreased, and that's probably because many people don't really expect to find a new job during the present conditions. It's also a fact that when you look at the number of clicks, when it comes to vacancies, the number of clicks per vacancy has been reduced by about 30%, and that's probably also because many expect not really much to come out of seeking a job under the present in the present environment. And job seeking as such, in terms of what type of jobs people are looking for, has also changed, because today there's more focus on occupations that allow people working from home, which is not really a major surprise. And the other part is that people are looking for what is called here essential jobs, for example, in the healthcare sector. And there are plenty of jobs in the healthcare sector presently, so that's not really much of a surprise either. Now, it will be interesting, given that this type of new data is available presently, what happens when we are, let's say, 6 months or 12 months into the future, because then it will be possible also to compare to what extent this type of job seeking behavior gets back to something which is normal, or if things really change. Now, what does this mean then when it comes to structural unemployment? Well, from a central banking perspective, generally speaking, monetary policy can help stabilize unemployment around some long-term trend. But we cannot really, with monetary policy, change the long-term trend of unemployment. That's actually almost completely dependent on the structure of the economy, the structure of the labor market, and other things, but not really tweaking monetary policy. So what we can do, and what we're doing presently, is that we can support the economy, and we can help the economy as a whole by ensuring that there is ample supply of credit, hopefully the economy as a whole, to navigate through the crisis which is going on presently. But as I said, we as a central bank, we cannot fix this source of high structural unemployment. That's really hardwired, depending on how the economy works and is constructed, and the flexibility of the labor market, educational skills, and things like that. So the role of dealing with structural unemployment, that's actually falls on other structural policies when you try to improve the functioning of the labor market and do all sorts of things that you need to do on that side. From time to time, of course, we also have a domestic debate when people kind of say that we, the central bank, should fix everything. And then we also always come back and say, well, you might wish for that, but monetary policy cannot really deal with the structural aspects of unemployment. Now, if you look at the reforms that have been undertaken in our labor market since the crisis that we had in the 90s, U-star has been slowly falling. Not, as you can see here, if you look at the red graph, we have had very substantial swings around the blue graph, which is essentially also what you would expect to happen in a very open economy, because if there are global ups and downs, we will immediately be affected by that. And then once in a while, like in the early 90s, we had what I could call an own goal performance, which was not really very good, and unemployment went up substantially. And given, of course, since 1995, we had all sorts of different types of monetary policy, and also different ways of thinking about monetary policy coming out originally out of a fixed rate regime. You can draw the conclusion that really the equilibrium unemployment rate is not really what monetary policy can fix from one year to the next. What is, of course, very important in this kind of environment is to avoid persistently high unemployment. And that means that you really always need to think hard about measures to improve the functioning of the labor market. And you need to make sure that you maintain active job seeking, and that you have reasonably strong incentives to accept various job offers. You also need to make sure that you have various types of reskilling programs going on, so that people actually can change their skill sets and move on to those sectors of the economy where demand is high for new jobs compared to where they're coming from. Another issue, which is certainly an issue in our context, is to improve labor market integration of foreign-born persons. And that's because it takes much longer for recently arrived refugees or other immigrants to get absorbed into the labor market compared to those who are well educated and basically are born in this country. And of course, which goes almost without saying, you need to make sure that you have high quality education for the young. And part of that high quality education also needs to include vocational education that meets the needs of the labor market, because it sort of is pointless to have vocational education and you give people skills that are not really needed in the labor market in one form or the other. Now, given the circumstances, let me give you a short run through what is actually going on in the labor market from this perspective when it comes to migration, immigration, or emigration, depending on how you look at it, and what is happening in the very short run. Presently, basically, migration has shut down, and this creates various problems at both ends. And reduced labor mobility is an issue which happens to be of great concern in the very near future, because we have a number of firms highlighting how restrictions hamper cross-border mobility of people. When people can't move around the way they are used to moving around, you get all sorts of knock-on effects in certain industries that hold certainly in construction and in agriculture, given the type of economy that we have here, because we have quite a lot of people coming from abroad, both in construction and in agriculture, and all of a sudden people have to get back into construction and agriculture when they have been out of those sections of the economy for quite a long time. And this, of course, also hits the source of migration, because those who cannot come to us and work, let's say, in agriculture, they aren't going to get paid, and that of course then leads to a situation where there is a lack of inflow of income wherever these individuals happen to be coming from. And at the same time, when it comes to us, certain things cannot be done because we just don't have enough people to make sure to get those things done, for example, in agriculture and in construction. And that, of course, in the short run creates an environment where everybody is worse off. Then on top of that, which is not a major surprise, there's a political discussion, and I'm not getting into the political discussion here about migration. And if you look at this world map, you can see what is in orange and red, and these are basically high-income countries. They have imposed all sorts of restrictions on migration, and that means that on the one hand, all these countries also at the same time have a rapidly aging population, at the same time as they have various restrictions on migration, and that means that this is not at all a stable equilibrium. Over the next 10 to 20 years, my guess is that something will happen here. What will happen, I just don't know. Now, looking at this in the very short run, if you can see here what has happened in the past few months, the blue graph shows elementary jobs and migration into the country in 2020 on the left side, and 2019. And if you compare 2019 and 2020, you can see two completely different worlds, because basically the blue line, which is now, is just flat, and the red line was going up. And then if you look at on the right hand side, you look at the high-skilled labor. Then the blue line is sort of pretty stable and was flat during the beginning of 2019. And then you can see there also the blue line, which is 2020, is just diving. And that means that major things are going on in our labor market presently. And that, I would say, is almost regardless of the design of monetary policy under the present circumstances. Now, so that was the short run. Now let me move on and say a few words about coping with the structural change. And structural change in the economy always affects the labor market in one form or the other. And structural change always also affects who is doing what, when, and why in different sectors of the economy. Let me start with a couple of reflections that are kind of very, very long term. Crisis and changes are ever present, and we have been through this many times in the past. Sweden has coped with crisis and structural change many times before, and if you take sort of like a 200 or 250 year time perspective, we used to belong to the poorest among the poor in the 1700s. And then mysteriously we got our act together and figured out how to do it, and that has brought a steady increase in our standard of living. Now, where does this come from? Basically, it comes from adaptability, willingness to change. That's where all those gains are coming from. Being both willing and able to do things differently tomorrow compared to the way you did them yesterday. Structural reforms can, of course, also from time to time go completely wrong, but you need to have some sort of an idea about what the policy framework should look like in order to foster structural change, because structural change will produce higher growth one way or the other. If your national preferences are to freeze the way you do things, which is perfectly fine, because if that's what you want to do, well, then you pay a price for that, and that is usually lack of growth. But that's a value judgment. That's not about the economics of it all. Central banks in all of this can do their part, and they can do it by keeping monetary expansionary under the present circumstances, and by improving access to credit, which is what I have touched on a number of times already. Now, taking the really, really long view, going back to 1850, and there are many graphs here, so let me only focus on two of them. The blue graph shows the number of people working in the agricultural sector. And back in 1850, most people were actually farmers in one form or the other. And today, people working in agriculture is very, very low. And at the same time, the opposite holds if you look at the yellow graph, which shows private services. And private services have been increasing very rapidly lately and continues to do so. So essentially, what these graphs catch is how our economy has evolved over time, and how labor market also has evolved over time, where essentially people have been for a long, long time been moving out of agriculture. And since the late 1960s, early 1970s, people have also been moving out of manufacturing, and more of this is services, either in the public sector or in the private sector in one form or the other. Now, at the same time, and this is a perennial debate, does this mean that that you are losing employment opportunities? The blue graph shows the percentage of people working in one form or the other to population as a whole. And if you look at the blue graph, you can see that it's been pretty constant between 45 to 50% for 100 years by now. And that just tells the story that it's fully possible to move employed people from one sector of the economy to another sector of the economy. And over time, people actually figure out how to do it. And there aren't really any major changes in the economy in terms of the number of people employed, despite the fact that in the near term, there is also always a lively discussion about this sector or that sector of the economy actually shrinking, jobs in our context moving, let's say, from Sweden to Korea to Portugal, and then from and to other parts, China and other parts of the world. But the key to all of this is actually then, in our case, the key has been to move out of manufacturing and agriculture into services in one form or the other. And this, of course, differs quite a lot from country to country, but the basic process is the same. Let me show another graph, which is not so much dealing with the labor market and where people work. This is showing the increase in real wages for the whole economy, and the final numbers from 2019 are preliminary, but that doesn't really matter. If you look at 1960s and beginning of the 70s, and this is what I've chosen to call the post-war period, we had a good run. It's not surprising at all that that was the case, because many countries were destroyed during the war. In the Swedish economy, Sweden wasn't part of the war at all and stayed neutral, and that means that the capital stock was not destroyed, and then there was an enormous pent up demand for goods and services in the world as a whole. And that, of course, led to a rapid increase in real wages. Then we have the mid-70s until the mid-90s. And here I've chosen to call it poor macro policies. Because given the good run that we had in the 60s and in the 50s, which is not here on the slide, that led us to believe that we did not structurally have to change. It led us to believe and think that we really had figured it out, which was not the case. And then we ended up with fiscal problems. We ended up with a banking sector problem. We ended up with a foreign exchange problem. We ended up with a general debt problem and a long, long list of issues that we had to deal with. Then eventually there came a day of reckoning. We were at the end of the road. And then we had to put the pieces back together. And then from 1995, during great moderation until today, you can see a steady increase in real wages. Now, when what is called here, the right-hand end of the graph is called the post-financial crisis. You can also see that in our case, real wages have been increasing since 1995 until today, which is actually quite successful when you compare to many other economies. And why is it then that the post-financial crisis did not really affect us? The reason I think is very simple. This time around, when we had the global financial crisis and things blew up, we were okay when the rest of the world was not okay, and that saved us. That's not saying that we will always be okay, because in the 70s, 80s, and 90s, it was the other way around, because back then the rest of the world was okay, but we were not okay. And that's why you see these differences when you look at these graphs. But essentially, what my point is that if you look at this from the 1960s, and you could actually show a similar graph that goes all the way back to 1850, you just have to accept structural change, because without structural change, real wages won't go up. And there's no free lunch. There's no free lunch in this, and that's essentially the story. Despite the fact that I chose when I put this material together to start 1960 and not 1850, but this period sort of catches the gist of the need for structural change, because structural change actually increases welfare for everybody. And structural change is also part of economic policy and economic policies, and how you think about those policies. So let me then summarize this highly unusual topic dealing with the monetary policy and the labor market at the same time. Structural reforms and clear rules of the game are very important when it comes to creating and fostering good economic developments over a long time period. One example of the clear rules of the game is an inflation target. And if you have an inflation target, if you can stick to your inflation target or get reasonably close to your inflation target, that sort of makes it easier to deal with all these other transitions, let's say in the labor market, that I have just talked about. Monetary policy in this context, particularly in the short run, can deflect some of the economic shocks, and monetary policy can also help prevent financial market turmoil, because if the financial sector runs into trouble on top of all the real economy problems that all of us already have, then of course everything gets worse. But structural policy is also needed to address structural problems in the labor market, and that holds particularly if you have an ambition to bring the long-run average unemployment rate gradually down. Monetary policy cannot fix this, and especially at the current juncture, when structural change might become even more rapid, given what is going on presently in our type of economy, it will be actually quite important to think hard about and what kind of structural policy measures would make sense, and then essentially just at the end of the day accept that structural change will come in one form or the other, and then one should support that as much as possible. So once again, thank you for listening, and thank you for spending some time with me reflecting on these issues both in the near future, in the near future, and what's going on presently, but also taking a long-term 200-year perspective. Thank you. So now I'm ready for questions.
Yeah, thank you, Stefan. Thank you very much indeed. I actually find it particularly reassuring that you, as well as the Governor Smali, yesterday reiterated that the monetary policy could not be the only game in town, and the structural problems should be addressed by structural policies. Yeah, there is now time for Q&A. I have already one question. I would now spell it out, and I kindly ask participants to type in their questions, if any. So there is a question from Yuri Gorodnichenko. COVID-19 is the global health issue, but the policy response has not been much coordinated across countries. Do you see scope for more coordination of central bank actions, other than swap lines, to fight economic effects of the pandemic?
There's no formal coordination among central banks, but at the same time, if you look at where interest rates are, at least among the major central banks in the world, basically everybody has ended up in the same place. Which is saying that rates are very close to zero, and at the same time, completely without formal coordination, many central banks are doing, among the major ones, roughly the same thing, because when you are close to the lower bound, and we can discuss the topic if zero is proper or minus this and that is proper. But generally speaking, rates are very low, and then a very large number of central banks actually use their balance sheets instead. So the major central banks of the world are massively expanding their balance sheet. So there is a very, very substantial money creation going on. But it's absolutely correct saying that that's going on without mechanisms for global coordination, because so far at the global level, no one has been willing to give up their sovereign right to decide their own monetary policy. And then, of course, the other part of it is the whole issue of swap arrangements and things like that. And that issue has been discussed many times in the past. And the fact of the matter is that there is no appetite presently for global swap lines. And the reason for that is very, very simple and very basic, and that's because almost all central banks have a national mandate. And that means that it's hard for them to, hard for the major central banks in the world to sort of deal with this at the global level. But having said that, it's absolutely remarkable what the Federal Reserve has done in the past few months in terms of providing dollars to many other central banks and the many banks at the global level. Because when this whole process started, dollar rates were going up, and we were on the verge of ending up with a situation with serious dollar shortages at the global level. And as far as I can judge, those global dollar shortages have gone away, and gone away almost completely, because dollar rates are actually back to where they used to be. Having said that, though, that's not at all saying that individual countries can have issues, because that is certainly that certainly remains the case. But it's a reality that at the global level, we just don't have global coordination presently, and the second best is basically the IMF.
Thank you. Yeah, and there is another question from Yuri. I think we all agree that fiscal policy has to play an important role in responding to the crisis. And how do you see the coordination between fiscal and monetary policy? Do you see any challenges in this respect?
This differs actually quite a lot from country to country, because in an EU context, we have independent central banks. And it's sort of anathema to independent central banks to all of a sudden start coordinating with the finance ministry, because usually it's been a long struggle to distance yourself from the finance ministry. But having said that, it's obvious that there are elements of coordination anyway, because I mean, we have bought over the past 5 years roughly 45% of the outstanding government debt. Now we have done it on our own, and all the decisions are ours. But of course, that affects what you do on the do or do not do on the fiscal side. And if from a monetary policy perspective, central banks buy government debt in order to ensure functioning markets and in order to ensure that there is ample liquidity in the system, indirectly, that's kind of also something which is probably quite helpful on the fiscal side.
Thank you. There is another question. Actually, there are a few questions, and I would start with a question from Federico Ravenna. In your opinion, how should the transition to a post-COVID economy, possibly structurally very different, very transformed, how to be financed? Support credit institutions or let the market take the lead? Have government provide financing directly to firms? What are the dangers you see across these different paths?
Well, there are dangers with there's dangers with everything, and you can have all sorts of views on this, and it's hard to find optimal policies. I mean, if you're an academic, you can think hard and should think hard about optimal policies. In the real world, you always act or react in a second best world. So you try to do your best, do what is doable in your own national and environment. Where one needs to be careful, though, thinking about this is the combination of what you do on the monetary side and what you do on the fiscal side, and where the credit market ends up somewhere in the middle. And what you can do on the central banking side, which is what we do and many other central banks do, is to provide ample liquidity and access to central bank funding to the financial sector. But having said that, that only ensures that you can stabilize, hopefully, the supply of credit. But if this goes on for some time, which is likely to be the case, at least in some countries, then with a fairly high likelihood, liquidity issues and credit issues will transform themselves over time into solvency issues, or actually de facto insolvency issues. Central banks and supervisory agencies are not really constructed to deal with insolvency issues. And particularly if you have all sorts of serious problems in the real economy, there's going to be a lack of equity. And if there's a lack of equity, then somebody has to come up with that risk-bearing capital. And that's very, very important, at least in my personal view. And when I talk about these things, people find it very surprising when I say that, well, central bankers are trained, and it's in all the textbooks, to act as lenders of last resort. But when things are really, really difficult, then de facto governments end up, like it or not, owners of last resort, because there is no one else around. Now, having said that, and wearing for a couple of seconds my old IMF hat, that leads to a situation which can be handled in some economies and which cannot be handled at all in other economies. And that really depends on the structural setup in the respective economy, whether it's a good thing or a bad thing to have the government owning stuff. And that's a very, very difficult policy issue to deal with, because once there is a lack of equity, and when government ends up investing in the private sector, then to make sense of those undertakings, then the government has to have the capacity and the ability to act as a private sector investor, not the way governments usually act, because then that ends up just destroying capital. And that is really, really the hard part and the difficult thing in this. Ideally, when it comes to policy mix, you'd like to come up with policy measures such that you restore aggregate demand and aggregate supply as quickly as possible. Because if you can come up with that type of a policy mix, then that means that the capital stock does not get destroyed in the meantime. And that's when it's much, much easier to get back to normal compared to if you also have a lot of destruction of the capital stock, because then everything has to start from over. But there is no one single recipe. There is no one way of doing it in all countries. This certainly will differ from country to country. But when you do these things, trying to increase or stabilize aggregate demand and aggregate supply, it's imperative in my mind to always keep structural change in mind. Because at the same time, this is you should never waste a good crisis when it comes to structural change.
Yeah, and actually you mentioned your stint in IMF, and there is a question from Yuri Gornichenko regarding that. So you had a long and distinguished career at the IMF and dealing with a host of crises in emerging markets. What advice would you have right now for these countries in the current environment?
Well, in the current environment, you always find countries that try to defy gravity, hoping that you're going to get a ton of money from somebody else without conditionality. But conditionality is good for you. And you can try hard, particularly on the political side, to work very, very hard, not trying to comply with the IMF. But there's nothing to be gained from that. The only thing that happens if you hate conditionality is that you're going to lower your own standard of living. But this is very, very hard to explain to most people. So either you figure out how to do it on your own, or you run out of money. And when you run out of money, you're going to have to rely on what I call jokingly OPM, other people's money, and they want their money back. And since they want their money back, they set the conditions. So that's just the real world. And in the real world, there is no way around that. That will just be there all the time. And right now, the IMF and the World Bank, they are just inundated with requests of funding and financing. And I think we should be happy that these institutions actually do exist, and then try as hard as we can in individual countries to adapt and adjust our economies to these very, very adverse and difficult circumstances. Unfortunately, there is no free lunch in all of this.
Yeah, we all economists know, but for politicians, always that's a surprise. There is no free lunch.
Yeah.
Yeah, there is a question from Viktor Kazyuk. Sometimes it's said that the only independent central bank can really push governments towards structural reforms. Do you agree with this? So do you see a relationship between central bank independence and propensity to structural changes by politicians?
Well, this is a very, very delicate issue. I certainly don't have a good answer to this. And this really, I also think, varies from country to country, and what the political system looks like, and where you come from, and what you have in your backpack. For us, part of our independence is dependent on us not overly discussing fiscal policy. Because if we stay out of fiscal policy, the politicians normally stay out of monetary policy. But if we were to get too deeply into fiscal policy advice, then we would get plenty of advice back. So it's very, very delicate to find a balance here, and this certainly differs from country to country. I do know that in many countries, particularly in emerging market economies, it's not all that unusual that the central bank has more capacity than almost any other institution to discuss both macroeconomic and microeconomic policy issues. So in those types of economies, it's actually quite prevalent that the central bank is used almost like a trusted advisor to the finance ministry when it comes to structural policies and all sorts of other policies. But then it's very, very delicate to find the proper balance, because if you overdo it, then certainly somebody else will hit you back sooner or later.
Yeah. Okay, there are actually two questions from Silvia Abrizio on firm financing. One, has the Riksbank in its large package to face COVID-19 crisis also considered targeted auctions to small and medium enterprises? And maybe the second, I would now also spell it. Is there some evidence on whether liquidity has been redistributed across the whole size distribution of firms?
We don't have all that many numbers yet, because this thing has been going on only in very, very few months. If you look at the numbers in terms of the distribution of credit actually has increased slightly to large corporates and decreased slightly to SMEs. And I think that seems to be in line with the email traffic I get, because large corporates rarely send me emails complaining about the supply of credit, while various SMEs send me emails complaining about this bank or that bank. But back to the other question about us lending directly to SMEs. No, we don't lend directly to SMEs, because at least presently we just don't have a machinery to do that. We have monetary policy counterparties, and they are usually the banks and a few others. And we have no direct connection at all to SMEs. So when we provide money to the banks against collateral, and then the banks provide money to the SMEs. But the National Debt Office, they have constructed a guarantee program where the government guarantees up to, I think it's 70% or something like that, of loans from banks to let's say SMEs. So in that respect, there are many parts of the public sector dealing with this. And we also have another authority, the name of which I never remember, and they are actually supplying equity capital to SMEs or to medium-sized companies. So in one way or the other, the public sector sort of tries to get the money to where it needs to go. But what we do is fairly narrowly defined, and everything we do is via the financial sector in one form or the other.
Thank you. So we have 4 more minutes, and I have a few questions pending. So the question from participant is, from the post-Great Recession period, we learned that forward guidance and central bank communications are important and powerful tools for macroeconomic stabilization. What is the role of forward guidance today when uncertainty reached an extreme level?
Well, it's foggy out there, but that doesn't change. I mean, I'm sort of like an economic weatherman. So we produce weather reports on what's going on in the Swedish economy roughly once every 2 months, and that's important because we have a large number of people trying their best when it comes to doing projections. And I can't change the world when it comes to uncertainty, so you just have to live with that. And normally we have a sort of a base case when we publish our monetary policy report. But in the last report, as I showed you on the slides, we had 2 scenarios, scenario A and scenario B, because we just said that given the uncertainty out there, it would not make sense for us to produce a base case, because that it's highly unlikely that the base case actually would happen. But compared to many other central banks, we have produced a policy rate path by now for almost more than 10 years. And that's one way of designing forward guidance. But forward guidance, publishing a policy path is of course not absolute, because it's basically a projection. And if things change, we change. But at this juncture, basically our policy rate path is flat at 0. And that's just another way of saying that given where we are, it would not be meaningful for us to publish a very detailed policy rate path 3 years from now. because we just don't know, and that path would highly likely change many times before we get there. So now the forward guidance is basically saying that rates will stay at zero for the foreseeable future, and we are massively expanding our balance sheet. And if we need to do more, we will be doing more. And that in order to ensure that rates in the Swedish economy stay low. But that's, of course, under these very special conditions. The way we talked about monetary policy during the Great Moderation, when we felt that everything was nice, smooth, and completely controllable, and that we had understood everything, it's completely different the way we talked about it back then, and how we have to deal with the massive uncertainty that all of us have to deal with presently.
Thank you. And I think the last question for today is going for Vladimir Lipushinsky. Central banks are introducing new instruments, which were hardly imaginable before. At the same time, they continue to say that they are close to out of the ammunition and ask for structural reforms needed. Maybe it be that the politicians get the wrong perception of unconventional monetary measures, and then they can infinitely rely on them.
Well, I would actually not express it that way. It depends on how old you are and how long you've been doing this stuff and what textbooks you read. I read my textbooks during the Bronze Age, so I've been around for a long time. And the fact of the matter is that central banks have always used their balance sheets. And a central bank without a balance sheet is not much of a central bank. So what is called quantitative easing today was called in the 60s open market operations. So all these, what is called today new tools, have actually in one form or the other also been used in the past. It's just that it happened so long ago, so most people who study monetary policy today are not really sort of that familiar with those things. But I think the bottom line is very simple and very basic. Either you set the price of money or you deal with the quantity of money. And if there is massive uncertainty out there, so it's difficult to judge how to get the most bang for the buck, so to speak, when rates are very close or already at their lower bound, then you basically do a bit of both. And given that it's hard to move the rate around a lot, then basically you expand your balance sheet. So then you move from price to quantity and hope that you get a better or more bang for the buck doing it that way compared to moving the rate up and down by, let's say, for the sake of the argument, 10 basis points or 25 basis points. Having said that, though, there is one very serious issue that I think would warrant reflections going forward. And that's really dealing with what kind of bang for the buck, what effect do you get out of monetary policy under the present circumstances vis-a-vis doing it via fiscal policy instead. And this is highly interesting and serious, because in our environment with the dysfunctional housing market and with certain sort of very specific domestic features, then in this particular environment, everything we do on monetary policy very quickly will push up asset prices, and maybe also probably one way or the other depreciate the exchange rate. Now, if you were to do things instead on the fiscal side, then fiscal measures can actually be targeted in a very detailed way to those who have the highest marginal propensity to consume and those who have the highest marginal propensity to invest. While monetary policy in some sense rains down over everybody, and part of that money certainly goes into the financial sector and will push up asset prices and will substantially push up asset prices and increase debt. And whether that's an efficient way of using resources, we just don't know the answer to the answer to that. So that's really for academics to think hard about in the future.
Yeah, thank you. Thank you, Stefan, for this very interesting discussion. Let's hope that everybody, central banks, governments, health authorities, academic community would be up to their job, and we will overcome this crisis. It was very nice to have you with us. Thank you very much. Let's hope for better. Goodbye.
Yes.
And we now go on with our next session.
Thank you.
All right, welcome to session 4. I would go directly to Davide. So could you please share your screen?
It's working?
Yes, I can hear you. We see this. Yes.
Okay, great. Let me know when I can start.
Please go ahead. Yes.
Okay. Good afternoon, everybody. Thanks very much to Yuri, Marianna, and all the organizers for having organized this exceptional conference in these special and difficult circumstances. This is a joint work with Silvia Albrizio from Banco de España, Julia Estefania Flores from the IMF, and the usual disclaimers will apply on this sensitive issue. This paper tries to examine the effect of monetary policies, in particular US monetary policies, on key macroeconomic variables such as output, unemployment, inflation, and so on, as well as a distributional variable, both in terms of income and consumptions, and whether these effects are state dependent, so they vary across the business cycles, they vary during conventional and unconventional periods. Why this paper? This paper tried to go after one of the key questions that is at the stage of the policy debate. As we know, many central banks all around the world have introduced significant and unprecedented measures to fight the global financial crisis before and the coronavirus now. And it's often discussed that these policies may have side effects. One of these side effects is a financial risk and build up of financial risk, leverage, and so on. Another element that is often brought up is a potentially negative effect on income distributions. And up to date, there is not really much consensus, and there are actually completely opposite view. There are some that may have suggested that actually unconventional monetary policies has a limited effect on the real economic side, is mostly affecting the financial market, boosting asset prices, for example, we are seeing now, and by this channel having a negative distributional effect on both income and wealth. Others, including ex-president of the ECB, was suggesting that unconventional monetary policies has been extremely effective in sustained demand, in boosting employment, especially for those less skilled, and by this channels also to reduce inequality. As you can see, both statements, they typically refer to channels through which monetary policy can affect inequalities. But beyond these two channels, there are others. Monetary policy can affect distributions through its effect on inflations that have clearly a different effect if you are a low or if you are a high-income household. And any change in interest rate is going to affect savers and borrowers differently. So it's clear that depending which of these channels is empirically stronger, the ultimate effect could be that monetary policies can reduce inequality or can increase inequality. The first paper that have tried to assess this issue has been the paper by Oli, Yuri, and co-authors. They published the paper in 2017, but actually I remember when Oli was working, was a visiting scholar at the IMF in 2011, 2012, and he was working on this paper. And what they find is that expansionary conventional monetary policies not only boost economic activity, as we know in the textbook, but also it reduces inequality, if any. The effect is quite significant over the business cycle, and they find that they reduce inequality in income, inequality in labor earning, in consumption, in total expenditure. Since their seminal paper, there has been a rapidly growing literature, both from the theoretical and the empirical side. Just counting the last 2 years, the number of papers that I had the chance to read, there were actually more than 50. So it's clearly like something that is in the mind of academic, policymakers. Many institutions are written about this issue, including mine, which is coming out with a staff discussion note by the end of this year. So we try to extend this literature in 2 directions. One is first to extend whether the effect of conventional and commercial monetary policy has been different on inequality, but we do so also by looking at macroeconomic variables. And the second, we extend the literature that has looked at the state-dependent effect of monetary policy on economic activity, depending on the business cycle, depending on the size of the shocks, including recent contribution by Silvana and Greg this year, by looking at whether the sign of the shocks and when you implement monetary policy in the business cycle, it also affects the distributional, it also shape distributional consequence of monetary policies. How we address this question in terms of data, we follow Coibion, Gorichenko, and others. So we use the consumer expenditure survey provided by the BLS. The survey is great because it has data at quarterly frequencies that make exceptional for the use of the analysis of monetary policy shocks or any other types of business cycle shocks. It has 2 main limitations compared to administrative data. The first is that it excludes the top 1%, which, as you know, in the US has been one of the key factors of driving income inequality in the last 20, 30 years. And the second is that it doesn't have any information on wealth. So all the results that we can discuss now are mostly about the effect of monetary policies on income and consumption, and we can say little about the effect on wealth. That said, some of the channels through which it's going to affect consumption is because of the effect of monetary policy on wealth, so we can implicitly and indirectly say something. We look at, as I mentioned, 2 measures of income, total income, in terms of business income, financial income, wage, and transfers, and labor earning that is more precisely estimated in the survey. We also look at the 2 measures of expenditure, one based on durable and non-durable, that we define consumption, and then other additional characteristics. And in the paper, we systematically report the results for 3 measures: distribution, standard deviation, 90-10 percentile difference, and the Gini. In this presentation today, just to focus on terms of space, I will focus on the Gini, but most of the results will hold also for all the other measures. Let me give you a snapshot about the data. As you know, there's been a trend increase in inequality, especially for income and earning. This income inequality has moved by more than 20% in the last 30 years. Interesting, and this is something that has been pointed out in the US as a specific case, we see that you don't see much of a steady increase in consumption inequality. And this is different than other advanced economies where you have seen both income and consumption inequality to go up. And it is often discussed that US consumers are able to, still through finance, to still keep their expenditure high, and this is others have discussed this may actually have led to imbalances in the US. In terms of cyclical component, and not so much. Typically, these measures are acyclical, except for expenditure consumption inequality, which are typically a bit counter-cyclical in the sense that inequality tend to increase with higher GDP and lower unemployment, and vice versa. What about the monetary policy shocks? We try to use a standard approach in the very recent literature. So ideally, we want to cover the most recent period, so we can use Romer type of shocks. So we use the same vein of paper by Gloin and others. We use high frequency data combined with the proxies for approach. We extend this recent literature by allowing for a structural break in the VR before and after the central bank has hit the zero lower bound. In terms of baseline, we use a 1-year government bond rate as a policy instrument as it still moves during the QE period. And we use the current month's Fed Fund future as instrument the paper shows that typically the results are very strong for any combination of policy instrument and policy value. Just before to turn to the methodology, I will show just this for positive and negative recession expansions. It's important to check whether there is a mass of positive shocks concentrated in a given state to look at these results in an independent way. And this is what seems to happen in the sense that the number or the frequency of the positive shocks and negative shocks is very similar between expansions and recessions, and the same if you look at the conventional and unconventional monetary policy shocks. In terms of methodology, we use the one by Cobion and others as a baseline, but what we do is we extend in three directions. The first, we extend to check whether the effects are different between positive and negative shocks. We use the second equation here, where D is a dummy for positive shocks and zero otherwise. We extend to look at the impact during the business cycle, and we use standard smooth transition functions used by our Bakri Korychenko, but also by Silvana and Greg in their paper on monetary policy. Here, what we use is as a smooth function is based on GDP growth. What we do is to not confound the effect of monetary policy with economic activity, we use a backward 7-quarter average. We also modify these equations to look at the fact whether monetary policy shocks have been at different effect during the conventional and the unconventional periods. In this case, our indicator variable takes 1 after 2008 Q4 and 0 otherwise. We estimate all these three equations from all the data that are available from 1980 to 2016 Q3. Okay, before to turn to this effect of the varies across all these different regimes, we did some cross-check on how results were different or similar to the evidence provided by Cobion and others. So we look at the effect of GDP on unemployment rate, on different income variable, and you see that standard response, something that is a bit puzzling is business income. I will return to this towards the end of the presentations. Another something that is important to flag is the response to transfer income, which of course matters for income inequality. So what you see is that after a tightening, transfer income tends to increase, and this could be due to two factors. One is that the fiscal authorities, they try to compensate for tightening by expanding expenditure, especially on transfers. The other could be that some tightening that typically occurs in periods of expansions, and this is the periods where transfer are mostly provided because they are more pro-cyclical. In terms of inequality response, we find the something very similar to what has been found by Cobion and others. We find that following a tightening, there is an increase in the income inequality as measured by the Gini, as well as the other variables for income, earning, consumption, and expenditure. So if any tightening in monetary policies tends to increase inequality. And this is also provide an indirect test of what has been done previously in the literature, because these results are based for two different periods and for two different types of exogenous monetary policy shocks. Now let's turn to the state-dependent variable effect. So the first we look at whether the response is different between positive and negative. Again, for the key macro variable, we confirm some previous results in the literature suggesting that tightening, they typically have a larger effect. Here for negative shocks, for expansionists, we turn the signs to coefficients to compare the magnitude of the impulse response. You see that positive shocks have larger effect on output and employment in absolute value compared to negative. The same applies for all the income categories, and the same it also applies when you look at the measure of income inequality. You see that tightening they have a larger effect for earning and consumption inequalities than easing monetary policy shocks. How these effects are different, whether they are statistically different, what we do in this table, we report the cumulative response for output and employment together with the t-test of significance. as you can see, that the effects are statistically different, statistically stronger for positive shocks than negative shocks. Here we report significance level based on a Newey test. Results are very similar if you account for the fact that the variable is estimated. So if you do confidence test based on bootstrapping startup error. And again, similar pattern we show also for the measure of inequality. Again, we present the cumulative response functions. And again, it seems to be the response of Gini, for example, in Gini seems to be statistically different, at least at the short-term horizon, than for negative shocks. Sometimes these responses are not statistically different, but this is mostly due to the wide confidence bands associated to negative shocks. What about expansions and recession? For key macroeconomic variable, GDP and employment, we find something similar that has been found by Silvana and Greg using Romer type of shock. So they typically find that the response, monetary policy is more effective when it's pushing on a string. So monetary policy has a larger effect during periods of expansions. Our point estimates that they go in the same directions using a different combination of shocks. Here we want to emphasize two important results. What is happening in expansions? We see a much larger deflationary effect than recessions. And second, we see a larger response of transfers. And these are two key elements that will have a bearing of the response of inequality measures during expansions and recessions. For income, again, we find for most of the income component, we see larger response to business income, to wage income, and to financial income. What happened to income inequality? Actually, we see larger response in recessions than expansions. And the weak response in expansion seems indeed consistent with what is happening with inflation and transfer. So we have a more deflationary effect in expansions and larger transfers. And both factors tend actually to reduce income inequalities because low-income households are those that hold more liquid assets, so they are more affected by deflation, but they're also those that typically receive transfer. So in both situations, actually, this helps improving the purchasing power of household at the lower end of distributions, and that's why actually we see this inverted response for consumption inequality. What about conventional versus unconventionals? If any, we find that the response of monetary policy shocks during the unconventional monetary period has been at least as large as what we have seen for conventional. The magnitude, the effect for output are nicely precisely estimated. The magnitude is actually even larger, suggesting that unconventional monetary policy probably has played as an important stabilization role as much as conventional policies during the earlier periods. In terms of income, we see a similar response. The only thing that is puzzling is about business income. And partly we think that this is due to a structural break in the survey in 2013 that may lead to this puzzling response of business income. In terms of inequality, again, we don't see much difference. We see that, if any, unconventional monetary policies, expansion in conventional monetary policies has helped to reduce inequality as well as a conventional one. Let me summarize the key results of the paper. We find that monetary policy tightening, they typically have a larger effect for both macro and distributional variables. The effect of monetary policies on output as well as on income distributions varies across the state of the business cycles, but in a different way, in the sense that the macroeconomic effect of monetary policy they tend to be stronger in expansions, while the distributional effect in recessions. And we think that there are two factors that explain these results: is the inflation channels, the transfer channels that play a significant role, especially for consumption inequality. And finally, something new, we find that there's been argued that monetary policies and conventional one has not been very much effective. Our results they tend to suggest that this has not been the case, in the sense that unconventional monetary policies has been as much as effective in stabilizing output than conventional one, but also didn't have any side effect in terms of income distributions. We check the robustness of all these results. We look at the different combination of shocks, policy variable instruments, state variables, so instead use GDP growth, we use either the CBO output gap or the unemployment rate. The results are old for any lag structure and so on. In terms of implication, there are two. One is, again, about the important role of unconventional monetary policies, and the other, more in terms of academic implications, is that we know that there has been a significant effort to allow heterogeneous agent model to incorporate a potential distributional effect on monetary policies. We think that this has been great, but there seems to be significant non-linearity, at least in the data, in the way that monetary policy shocks affect income distributions. So we call for this model to allow for greater non-linearity. I stop here and looking forward to hear the comments of the discussion. Thanks.
Great, many thanks. Miroslav, I will now.
Yeah, hi, let me just share the screen. You can see that? Yeah,
yeah, we hear you, we see everything. Thanks.
Yeah, thanks, thanks, David. That was a very interesting presentation. I have to say I really enjoyed reading the paper. Might be my personal bias because I'm very interested in that type of literature, but I think it's a very nice exercise. I'm not going to probably spend too much time on the summary, given that you just summarized everything. But I think there are a couple of very important and interesting results. When you compare the expansion and contractionary policy, that you show that okay, they're both symmetric for the aggregates, but they can potentially have asymmetric effects of inequality. And I think that's a very novel, interesting results to put. In terms of recession versus expansion, as you just mentioned, that there is effects on inequality that is stronger in recessions, so there is more room for more aggressive policies in the recession versus the expansion, and I think that's going to have interesting implications. And then, of course, and I think from my understanding, that's the main selling point of the paper is the conventional versus unconventional monetary policy, that they are as effective in terms of the aggregates, and they're also as effective in terms of inequality. I think that's very interesting results. Now, in terms of the comments, I sort of to give a heads up, these are going to be sort of biased towards what I do and what I would like to see in the paper. So they might seem a bit irrelevant maybe for the bigger question, but I think that's something interesting that can be done. And they're going to be essentially based on the exploit-rich heterogeneity of the data that you have in hand. So one of the things that you mentioned is that the wealth data is either non-existent or is not very reliable in the consumer expenditure survey. I think there is the way to get around that. So if you look at the James Cloyne and his co-authors, there are two recent restarts where they tried to proxy the wealth by the housing tenure of the households. And I think that's very interesting because what they show essentially is that consumption response is very different to monetary policy shock depending on different types of groups or different types of households. And I think you can go along by also showing what happens to consumption inequality, what happens to sort of inequality between the groups and inequality within the groups. And I think that can also give a couple of new interesting results. Of course, there are potential issues with that. So the first one is, of course, the endogenous changes in the group composition. You want to make sure that the types of policy shocks that you analyze do not actually make people switch from one group to the other. And I think in the Cloyne, Ferreira, and Surico, for example, they addressed that pretty well, showing that conventional monetary policy shocks do not trigger any endogenous changes in the housing tenure status. I think there are two ways to look at it, either to extend it to unconventional monetary policy and see sort of the first novel result could be whether maybe new measures or the recent measures of monetary policy, whether they do induce people switching, for example, from being renters to being homeowners, or if you find that this is not the case, you can also show that you can kind of extend the sample and show what happens to consumption equality for these different groups. And then, of course, there's endogenous selection to these groups. I'm not going to spend too much time on that. And kind of to support my point, so this is using the Spanish survey data, but I think it's pretty similar to the US, that these three groups of households that James Cohen and his co-authors they analyzed, they do actually look very different in many dimensions. When it comes to net financial wealth, when it comes to net housing wealth, so these are all the numbers in euros. When it comes to labor income, the level of durable consumption, and the labor income Gini, I think there's a lot to be exploited in, especially given the rich data set you have and how did you extend up to 2016. I think there's a lot of interesting things that could be done by looking at these three groups differently, and I think that could actually give you a step forward to saying something about at least the wealth position of the household. Maybe not the wealth inequality per se, but at least a proxy for that. The other comment, again, it's still going to be biased towards my personal interest in that kind of literature, but I think the age, or if you want age/cohort component, can be very important for the propagation of monetary policy or monetary policy transmission mechanism. For example, if you look at the Arlene Wong's paper on the refinance and transition of monetary policy to consumption, she shows that there is a very large response of consumption to monetary policy shocks, and it's mostly driven by the young individuals. And it more so she shows, so she goes even deeper to that, so she looks at two dimensions of age and housing tenure status, and she shows that the group of young homeowners are the ones that are the most responsive to this sort of shocks. I think interesting thing could be to look at the cohort effects, because if you think about the two different cohorts entering the labor market pre and post crisis, they entered in a kind of very different scenario, very different type of monetary policy that was conducted. So if you think of the young individuals entering during the conventional monetary policy period versus the ones that are entering the labor market post-crisis or entering labor market now, they're essentially facing an unconventional monetary policy. And I think that could be an interesting thing to see what could be the spillovers to the inequality. And again, this is just some very rough calculation, but if you look at the young individuals pre-crisis and post-crisis, so this is clearly just showing the sort of the cohort effect, there is a huge drop in their net financial wealth for the young individuals, their housing wealth, as well as their labor income, their non-durable consumption. There is more inequality in the labor and so on. And I think that could help you address not only the sort of the empirical literature or the ones that you mentioned earlier, but and I think that also the video you mentioned also in the last slide, there's a call for all these nonlinearities in the heterogeneous macro models. I think the paper that you have can provide kind of several interesting stylized facts that can be used to discipline this very broad literature on the effects of monetary policy, how heterogeneous there are, the overlapping generational literature, the hand-to-mouth literature, and so on. And I think there's, given the kind of the toolbox and the setting that you have, there's a lot of potentially many interesting results that you can get. A couple of very brief comments, which I'm going to call unfair and speculative, because it's not that I have a kind of explanation for them or some suggestions. But one of the things you mentioned in the paper is the extensive versus intensive margin of the labor earnings or labor income. And what you showed in the graphs is that there is a higher unemployment following the monetary policy tightening, and there are lower wages and lower salaries. And I think, of course, part of that can explain the increase in the earnings inequality. But this is more of a speculative point. Maybe there's a way to use the survey itself. So maybe trying to exploit the final dimension of the survey to try to identify which is the dominant channel in rise of the earnings inequality, whether it's due to the extensive margin or whether it's due to intensive margin. I didn't dig into too many details on that, so there's not too much I can say. But I think that could be interesting point to look at. Then there is a large debate, of course, on literature. I'm sure you're familiar with that, on the using consumption versus expenditure inequality and the problems with the mismeasurement. I mean, one of the recent references that I came across by Olivier, Yuri, and Dmitry about the frequency of purchase and how it has different effects on the consumption versus expenditure inequality. So people don't shop as frequent now, so that can have different implications on what you measure in the data. Again, this is more of a speculative point of which is the true measure of the inequality trends, whether we should believe more your results on consumption or more on the expenditure, and which will be the best tool sort of for the policy making. Again, I think given the data available, there's not much you can do per se, but maybe at least trying to address that. And then, yeah, I mean, this is just this is probably the most unfair comment, is that basically you show different measures of inequality. You show the 9 to 10, the Gini, the standard deviation, and so on. Do we actually need all three of them? Because it looked to me that at least quantitatively, all the results came through. There were some differences in the qualitative sense, but I didn't find them very different. So I think maybe if you just focus on one, it might be a bit less overwhelming in that sense to read. I think in what you did in the presentation, in presenting just one, I think that was exactly what I was thinking about. But again, that's up to of course up to the presentation of the paper. Let me wrap up. So, as I mentioned earlier, this is a super interesting paper for me, and I think it has many important results. As you mentioned as well, David, it's very policy relevant. So from the monetary policy perspective, of course, you want to look at what happens if you conduct expansionary versus contractionary monetary policy, whether you look at the conventional versus unconventional monetary policy. That's especially relevant now. And of course, when you apply those concepts to inequality, there's a lot of debate going on right now. So that's very relevant question. Again, this is a great addition to studying monetary policies in the microdata. So I think you have a sort of toolbox, if you want, for this sort of analysis that can actually give people a lot of interesting things to try even on their own, whether it's from the monetary policy identification itself or from the, as you mentioned, extending the original data by Olivier Jury and co-authors. Yeah, and basically my main comment, just to summarize, is that there's a lot of potential in the data. So why not use it more? Why not answer more questions? Why not dig in slightly deeper to all of that? Yeah, that's all I have. Thanks.
Thank you, Miroslav. Davide, would you like to address some of them, some of the comments?
Well, I think Miroslav did a great great comments, and it's exactly the way we're thinking to extend the paper. Indeed, both age and mortgage are likely to play a huge role because they are really different in the sensitivity, especially for inflation. This is what has been found, for example, by the paper by Olivier Jury. So if I remember correctly, what they do is they look at two categories of household. They look at the old rich household, and then they look at the young middle class household with fixed mortgage. And then we look at whether the effect of distributional effect, they are different. So we were thinking to extend the paper around these dimensions, and indeed, there is a huge heterogeneity that we can look at. In terms of measure, yes, I think we try to be as much as comprehensive and transparent in the presentation of the results in the paper. So probably there are too many results. Yes, and the way that we are going to submit to the journal, my sense is that we are going to decide what goes in the main text and what goes in online appendixes and so on. But yeah, great idea, great suggestion, and we'll take forward along the line that you suggested.
Great, thank you. So we have a first comment from Yuri, who's saying Miroslav has great suggestions on exploring heterogeneity in the survey. From his experience with the sex, the cross-sectional dimension is too small to have precise estimates, but maybe the IMF has more data.
No, we don't have more data. I mean, we really extended the same data that Yuri was using in their papers. We just extended up to the most recent periods. My fear is that the cross-section will be still limited, but another alternative would be to look at an additional data set, like for administrative data. But then the problem is the series are annual, so I'm not sure that it would be good to go in these directions. But I agree with Yuri that I think that the suggestions of Miroslav are great, and we should try to look at this more carefully.
Great. I would have two questions. So one is, we're looking at monetary policy shock, but could it be that at the same time we're experiencing also some form of fiscal shocks that are happening during the periods in which these monetary policy shocks are kicking in? You know, an expansion of programs, of coverage, increased transfers, things like this that were not announced previously.
My sense is that overall, for the entire analysis, this issue is so there is no systematic correlation between the fiscal shocks, you know, the standard fiscal shocks that you may think of, and the monetary policy shocks. My sense is that, however, when you try to restrict to the post QE periods, there could be an issue. So I think you know, one way to directly test is to check whether there is something going on when we look at the analysis of conventional and unconventional, adding you know, standardized fiscal shocks from the literature covering these periods and see if it's going to change the results. My sense is looking at the available series of shock, not much of a systematic correlation. So I doubt that it will change the results, but it's something that we can check.
Great. And then I had actually an idea which is going to make the transition to the next paper. I saw you're highlighting an asymmetry in inequality over the business cycle, and the next paper is all about asymmetry in the business cycle itself. So maybe we can learn something about the cost-skewness between these two measures. This would be something that perhaps would help elucidate this mechanism further.
Yeah, I think like I mean, the next paper is also talking about some measure of higher moment in terms of uncertainty and so on. Indeed, you know, there is a growing literature also that you know, by Nick and co-authors that look at whether monetary policy has been effective during the periods of high uncertainty. So another extensions will be to look at the smooth transition function, not only between expansions or recessions, but also during periods of higher low uncertainty. And if I believe correctly, I've seen a recent paper done by someone, a colleague in the UK, looking at the response of uncertainty to UK household data, and shows that the spike in uncertainty, they affect differently household at the different segment of the distributions. So another extension it would be to look at in the study band some sort of measure of uncertainty by Nick and co-authors.
Great, thank you. Do we have any further questions or comments, perhaps, from the panelists or from the attendees? Well, Davide, it looks like you absolutely clarified everything.
We have to have done so.
If there are no further questions, then I would suggest to move on to the next presentation. Thank you very much.
Thank you.
Fatih, if you could share your screen. Great.
Hi. Okay. Yes. Let me do this. This one. Sorry. Back. Okay. You can just tell me when I should start.
You have even additional minutes, so
okay. Good afternoon, everyone. Thanks for listening, and special thanks to Yuri and Mariana and other organizers for organizing this great conference and giving us the opportunity to present our work. This is joint work with Sergio Salgado at Wharton and Nick Bloom at Stanford. And the title is Skewed Business Cycles. So rather than describing what we do in the title or posing a question, the title in a way summarizes our conclusion. And you know, in the next 20 minutes or so, I'm going to argue that skewness, which I will define much more clearly in a few moments, is a very robust, significant feature of U.S. business cycles actually in economies around the world, and that it also matters for macro analysis. So today I'm going to talk about firms, but I want to make an introduction, especially because this is also a conference about labor markets. I want to give a motivating example from the labor markets to motivate, you know, what we are doing with firms. So this is a statistic that I find quite fascinating. If you look at the US Great Recession between 2007 and 2009, during those 2 years, you look at the mean wage income change for US male workers, it was about 6.5% drop in mean. So this is well known, and at that time it was the deepest recession in the post-World War II era, and we all know how painful that recession was. But now I'm going to change one word. Instead of mean, I'm going to look at the median wage income change, because at the end of the day, right, we have a distribution of wage changes across all workers, and we often look at the mean, the aggregate notion. But if I look at the median, actually there was no drop at all. In the deepest recession post-World War II, over 2 years, the median wage change was pretty much zero. Now, how can this be? How can the mean fall so much when the median barely moves? Because the distribution of wage growth rates have become much more left skewed during the recession. So this will be a recurring theme in the paper today as well, that not only, you know, the aggregates are also driven by the changes in the entire distribution. And just to, you know, drive this point home, if you look at the same years, the 2 years during the Great Recession, about 1 in 10 workers actually saw 50% or more rise in their wage income. And another 10% saw a drop of 60% or more during the same time. Now, maybe we will think, well, that's not surprising. There's a lot of heterogeneity. That's true. But when the mean changes are in the order of like 1, 2, 3, 4, 5%, and the entire distribution is so widespread, changes in those distributions can actually have really first order effects on macro and business cycles. So today I'm going to switch gears and I'm going to talk about firms. And I'm going to ask 2 questions that in a way parallel the statistics that I just showed you. The first one is, does skewness of firm growth rates fall in recessions? And the second one is, does it matter for business cycle analysis? Should we care for monetary policy? Should we care for any other aspect of recessions that we really worry about? And I'm going to try to convince you that the answer to both of them is actually strongly yes. So to fix ideas, let me start with, think about like a variable that we care about. So I'll talk later about sales growth. So think about the sales growth distribution across firms in an economy. And for simplicity, the histogram, I drew it such that it's symmetric in an expansion. So one view of what business cycles do with heterogeneity is that it is a symmetric downward shift. Okay, the whole distribution shifts to the left, but not by much. The mean change is not too big, but there's an expansion in the dispersion. So this is the counter-cyclical variance view, and it has been analyzed thoroughly, both for wages in the past 20 years, for wage incomes, for wage income growth, as well as for firms, productivity, and so on. And this is also kind of another language for this would be uncertainty shocks. You know, if you take this to be the conditional distribution of outcomes tomorrow. Now, I want to draw your attention to one point in this figure. Notice on the right side, the red histogram for recessions actually lies above the blue one. So when you take the actual numbers, empirical numbers for how much the variance is assumed to be rising in recessions, there is a large number of firms under this view that are experiencing faster sales growth in recessions than in expansions. And this will come back, and this will actually be very important. And this will be a key difference between the view about a countercyclical variance as opposed to a change in skewness. Because you might be suspicious, what are these firms that are experiencing, we can give anecdotes, one or two, but if you do the calculation, for example, for wages, about 1/3 of workers will get larger wage growth during recessions if you take the numbers. So keep that in mind, we'll come back to this point. An alternative view is that maybe it's not a symmetric shift, a recession, but it is a change in the symmetry of the distribution. By the way, at the end of the previous talk, this came up again. So I would like to emphasize, we can talk about the distributions of levels or distributions of growth rates. And as you know, the two are very different objects and they can have very different properties. So throughout this talk, the focus is always about growth rates. So here it's annual sales growth, wage growth, and so on. Okay, so please keep that in mind. They will be quite different. So the second view is that, well, maybe a recession is this change in skewness towards left. What does that mean? Well, on the left tail, bad outcomes become worse outcomes. In another language, you can say the downside risk increase in recessions. But on the right-hand side, we don't see an expansion of the right tail like we would under countercyclical variance. Instead, we see a contraction. So in other words, like a stellar firm that was going to grow, at 50, 60%, they will grow at 30% under this view. So the upside potentials will decline. So this is the procyclical skewness view. In expansions, the right tail expands, the left tail contracts. In recessions, the left tail expands, the right tail contracts, and the skewness fluctuates. So this is true for workers. If you look at wage growth for workers in, I and others, we have looked at this for about 15 countries, different set of authors. And it's like clockwork. In every country that we looked at, the skewness of wage growth is very strongly procyclical by very large magnitudes. So today I'm going to look at firms. Now, because this is a short talk, there's a chance that I won't get to every figure and every result. Let me give you a brief summary of what we do and what we find, and then I will actually show you as many of the results that I can. The paper has two parts. The first part is an empirical analysis where we study the distribution of firm growth rates and the firm level productivity. We are going to use data from the US, both for private firms and public traded firms, from Census, Compustat, and other data sources going back to the 1970s. We are also going to have, I would say the more ambitious part is, we are going to have a panel of about 45 countries and covering more than 20 years, public firms, private firms. It's a pretty large data to analyze. And the main result will be what we'll call a new business cycle fact, that a robust feature of business cycles is that skewness is procyclical, meaning what I just said, that the left tail expands, downside risk rising recessions. At the same time, the right tail contracts. If you don't have the right tail contracting, if it also expands, that is the same as increasing variance. Okay, and the two actually will have quantitatively and qualitatively some different implications. So the risk is asymmetric, and the asymmetry fluctuates over the business cycle. And it's a very robust feature. As we have done pretty extensive robustness analysis. It's true across countries, within industries, by firm characteristics, and so on. We also have some VAR evidence. in a VR context, a skewness shock to the economy will create a persistent decline in both output and employment. And the effects will be more prolonged than an uncertainty shock, and it will also be deeper than that effect. Then we are going to switch gears, and we are going to take these facts and put it in a heterogeneous agent model with entrepreneurs that are risk averse. And we are going to have lots of bells and whistles that have been used in this broad literature. There will be borrowing constraints, there will be various types of adjustment cost to capital, and there will be idiosyncratic shocks to firms as well as aggregate shocks. And the key, if you will, innovation is that we are going to model idiosyncratic productivity shocks such that both the variance and the skewness can fluctuate over the business cycle. And we are going to quantify kind of the effects of it. So what is the bottom line? What's the macro impact of skewness shocks? Well, they are pretty substantial. If you take, for example, the empirically measured, skewness shock that we get in the data, it basically is followed by about a 1.7% decline in output, about a 1% decline in consumption, 15% decline in investment, and about 1.5% decline in hours. When you combine with variance and skewness, the effects are slightly higher. So let me show you now the results. I'm just going to flash the data sources. I think the discussant might also comment on them. But we have, like I said, we look at census LBD data, the survey of manufacturers, CompuStat, and cross-country. We look at basically both private firms, public firms, and so on. So the first one, I'm going to start from the bird's eye view, okay, the broad picture. Take again sales growth and look at annual growth in sales from one year to another. Then look at the histogram, the distribution of that, and average it across years that are expansion years, okay? And average it across years that are recession years. So how does on average the distribution change from an expansion to a recession? And it's very much like the picture I showed you before, where the blue one actually, during expansions, this is US data, the sales growth distribution is pretty positively skewed. And when the recession hits, that's the red one. As you can see on the left side, the red line is quite a bit higher than the blue one, meaning that there are many more firms experiencing large declines. But look at the right side. You don't actually see the right tail expanding, okay? And if you look at the numbers, they actually slightly contract. Now, this is the average. How about if we look at, the time series of this? So again, same variable. I'm not gonna use a summary measure, a statistic that is very helpful for measuring skewness. It's called the Kelly skewness. But by the way, we have done this with other, statistics as well. They're very robust. But the Kelly has a very nice interpretation. It's robust to outliers, and it's easy to map into kind of plain English sentences. That's why kind of we like it. So this is again the U.S. and the shaded areas are the U.S. recessions. And on the y-axis, I have the Kelly skewness. Look at, for example, before the 1974-75 recession, the Kelly skewness basically was at its peak, and then it crashes as soon as the recession arrives. And after that, it's really pretty much like clockwork. There's a few years out that look like a bit different, but if you look at all 5 recessions, the skewness dips significantly. Now, if you look at the averages, the blue is the average across expansion years, the red is across recession years, and you get the numbers I showed you just a moment ago for the histogram. How about, look at not CompuStat, not only publicly traded firms, but look at all US firms from the census, employment growth. It has the same pattern again. Every recession, the skewness dips and then recovers as soon as the recession is over. Like I said, the Kelly skewness, these numbers are big. They are quantitatively actually major changes in the distribution. And we'll see also when we look at their implications. Now let me go from the US to 44 country panel. So let me tell you how to kind of read these figures. Let's look at the one on the left, the employment growth. One of these circles is a country year. So for a given, 2-year period in a given country, that is the Kelly skewness of employment growth distribution in that country. And we plot that against the average growth in employment in that country year pair. So what you see here is that when employment growth is strong in a country in a time interval, the Kelly skewness of employment growth in that country is also more positive. And the relationship is surprisingly strong, like they almost line along the same line. And the slope is also significant. If you look at the total variation in the Kelly skewness, this is a statistic that ranges from -1 to 1. So variation from -0.15 to 0.45 is actually a very large variation. And on the left, you see the same for log sales growth. What if we move from now country level results within each industry? So suppose I treat each industry as an economy and look at the skewness within industry skewness. How does that vary with the industry business cycle? Oops, okay, I jumped ahead. So before that, the results I showed so far are about employment growth, sales growth. They are outcome variables. They are not really like shocks. So I want to look at shocks or something close to it. So we can estimate TFP shocks at the firm level. And this is the same structure of data as in the previous figure. Again, country year pair, but the Kelly skewness is for the TFP distribution. And again, you see an upward sloping graph. The left side is international data, the panel I mentioned, and the right side is the US Census of Manufacturers. Now let's look at within industry. So suppose now I take within the US, each industry as an economy. And just like we have the stock beta, say in CAPM, think about the skewness beta for each industry. So this will measure how the skewness co-moves with the cycle in that industry. The main takeaway is, look at the bottom of the figure, the 0 line. Okay, every industry you see here they have a positive beta, meaning that they have procyclical skewness. Okay, without any exception. If you do this for the variance, by the way, you actually get you don't get a picture like this. Okay, you don't get the beta that is significantly positive. It's around 0, and it's positive and negative for different countries. So what is the macro impact of a change in skewness? In the interest of time, let me just mention this briefly. We did a VR analysis with monthly data where we put some usual suspects as macro variables, but we also include both a volatility measure and a skewness measure. And the skewness measure is the cross-sectional Kelly skewness of stock returns. And when you identify the skewness shocks, the effect on industrial production, you see a fairly sizable decline on the left, and it is again fairly persistent. On the right, you have for employment, which is even deeper and more persistent. Just to give you a comparison, if you do the same for uncertainty shocks or volatility shocks that are, we use more often, the effect is less persistent, and for employment also less deep than the skewness shocks. Now, I'm gonna. So by the way, let me just stop here for one moment and summarize. The draft is online. We have a completed draft where we talk about various kinds of robustness, so different measures, different ways of computing, say the TFP, various subsets of countries, where you can actually estimate the beta for each country. And then it turns out that there is almost very few exceptions, that country by country, actually the skewness of the skewness of the variables I showed you are robustly cyclical. So combining this with my first slide, where I talked about the wage growth distribution also being procyclical, the skewness being procyclical, if you put these two together, we have this view of the economy, of business cycles, where workers on the one hand, the household sector, and firms on the other hand, both of their key variables, okay, the growth rate in wages, in sales, employment, TFP, they all seem to have a pro-cyclical skewness. So it seems to be, I would say, a really defining characteristic of a recession. Much more robust than I think the other ones that we often think about, we associate with a business cycle, which is a surprise. Like, you know, this is in a way, I'm summarizing also some other papers and work, but it's surprising how robust it turns out that distribution skewness change so systematically over the business cycle. Now we are going to take these facts and put it into a model. And I'm just going to give you like the very broad overview. This is a heterogeneous firm model with, like I said, risk-averse entrepreneurs, hand-to-mouth households. There will be idiosyncratic TFP shocks, just to remind you, with variance and skewness fluctuating, capital adjustment costs, and there will be portfolio choice between a risky asset and between basically entrepreneurial production and a risk-free asset. So I'll just show you the results. Okay, if you take this model properly, you know, calibrate, make sure that it behaves in a reasonable way, and then you hit the economy with a skewness shock, okay, in productivity distribution to the firms. What you find is that you get basically roughly a 1.7% decline in output. That is also fairly persistent. Again, I'm going to contrast this in a moment with the variance shocks, okay? You get about a 15% fall, immediate fall in investment, and then, you know, a recovery. And consumption declines by about 1%. Now, in these economies, as you know, we are not allowing, when you don't invest in capital, normally there might be other opportunities abroad, okay? And you might, you know, transfer your money to, say, Asia, to Latin America, wherever, developing countries where there are better opportunities. Here, we don't have that. So it has to go somewhere, that money, and then it goes, of course, into risk-free assets. So the bottom right corner is an artifact of that you put your money into risk-free asset. What's the mechanism? Very quickly, it's some familiar ones and some new ones. The first one is the same in a way as uncertainty shocks, right? There's a pure real option effect because there are fixed adjustment costs. A skewness shock is an uncertainty, you know, shock. There's more uncertainty now, and so what you do is you wait. Okay, that frees investment. Second, there's a rise in precautionary savings, again for the same reason, but in this case, it is quite a bit more powerful than a variance shock. And the reason for that is, in the variance shock, remember at the beginning, I showed this histogram and I said, pay attention to the right tail, because with an symmetric expansion of the variance, there is also potential good outcomes happening in a recession. Okay, so it's not all bad. The variance goes up, I might get much bigger negative shocks, but I might also get much bigger positive shocks. Here, you don't have that. Here, the world is looking down in recessions, and the left tail is expanding a lot more than what you would get with the variance. Quantitatively, you also get a bigger shift down. Finally, the Oye-Hartman-Abel effect that we have with in this class of models, when the variance increases, that's also an opportunity for, again, similar reasons, right? But here you don't have that because the right tail is not expanding. So you are hit by the bad left tail, but you don't get any upside potential that you get with variance shocks. So you put them together in the same model. So this is now the variance shock plus the skewness shock hitting simultaneously. And you get a similar decline in output, but now it is less persistent because the variance shock actually reverses and counteracts the effect of the skewness shock. Investment looks similar, consumption falls, but again recovers faster. And I would emphasize especially output and consumption. So you can put both of them together in the same model. Quantitatively, it looks like the skewness shock has a bigger effect. So let me conclude. Just to summarize the the results I overviewed. We document that the distribution of firm growth rates, looking at the sales, employment, and we have looked at some other variables that I haven't discussed today. That's also true for actually micro level stock returns. They are strongly procyclical. And the key thing is we don't have a symmetric expansion, a rise in variance in these distributions. We actually have a twisting of it. And that has important implications because you get the bad side, not the good side. And the quantitative model, like I said, shows that you can get a more prolonged effect out of skewness shocks. It is a kind of, I would say, uncertainty shock, but the nature of it is quite different, and it is much more robustly in the data in this whole cross-section of countries and variables that we look at. And that's all I have. Thank you very much.
Great, thank you. Michał?
Yes, hello. Yeah, visible, and okay, I'll try to share my screen. Okay, is it visible?
Yes.
Okay, so hello everyone. Good afternoon and good evening. Just put it on the full screen mode. Okay, so first of all, thank you for having me here. It was a really good, a great pleasure actually to have a chance to read this paper and also to have a chance to think a little about it and to discuss. Okay, so let me start. So first, I will take some time actually to take a small overview of the paper. First, I will start with the empirical part because actually it is divided into two parts. Okay, the first is empirical, as Fatih said, and the paper presents actually a broad empirical evidence that the dispersion, but it's actually more important, and what is actually the scope of the paper, also the skewness are cyclical. Okay, the former is counter-cyclical, we know that from different literature, but what is actually paper is showing is that the latter thing, also the skewness is pro-cyclical, and this is something very novel and something that we actually didn't know before. And these results are actually really very robust. There are a lot of actually these robustness checks on different levels that are present in the paper. First, there is the paper concentrates mainly on the US, and it uses different micro data sets and shows that actually it is really very robust. But it's also not also robust. This robustness is not only confined to the US, but it's also present in the number of countries on the micro data. And also the authors show that when you aggregate firms into industries, this pattern of the procyclical skewness is also present, at least in the US and possibly also in the other countries. And what is also quite important, this procyclicality of the skewness is found for both the shocks variable, so in a sense the TFP, but also for the outcome variables like the sales, employment, and also there are the analyses that show the stock returns. So it is in a sense visible both on the shocks that are affecting the economics, but also the way how that are affecting the firms, but also the way how the firms are reacting to these shocks. So the main results of the paper are, I think, on these two slides. Okay, the first is this distribution of the log sales growth, which, as Patrick said, it is actually moving to the left. In a sense, it becoming left skewed in period of the recession. And when you see it through the eyes of the time series, actually, it is visible that during a recession period, this skewness actually decreases substantially because it's a huge kind of decrease. It's a major kind of shift in the distribution. The second part of the model is more a modeling kind of exercise, and it's also divided into two parts. One is more empirical in the sense that it relies on the VAR models.
And from these VR models, the authors showed that the skewness, that the shocks to the skewness actually generates persistent declines of output. And this is completely different than shocks to the second order moments. And the left panel on this slide is showing these results. Actually, when you have a shock to the volatility, of course, the economy gets into the recession, but this recession is quite short. When there is a shock to the skewness, the economy is also in the recession, but by this recession is much more prolonged in time. There is much more persistence. So the authors also built a heterogeneous agent model with the capital adjustment cost, and they also specify a process, a stochastic process of the TFP that allows for this thing, for this time varying dispersion and skewness. And model also generates this persistent declines of the output variables, very similar to the evidence that was visible in the vector autoregression kind of exercise. And what's also important, this decline of the economic activity can also be generated within the model, even when the mean and the variance of the firm's shocks are held constant. So it is actually the pure shock to the skewness, and that is visible in the right side of this graph. As you may see, actually, this decline of the output is very persistent. The authors also showed what is the mechanism behind that, and this persistent drop in output actually is driven by the decline of the investment, which is the main, in a sense, ingredient of this model. And this is actually there are three channels that are stressed in the paper. The first one is the fact that when you have a fixed cost to capital adjustment, actually it creates a real option effect that actually reduces the incentives of firms to invest when the skewness is actually declines. So when the distribution of the firms moves to the left. Why? Because of the fact that in this kind of world, only outcomes about the bad state of the world actually matter for this valuation of the option to delay the investment. So that's why assess firms want to delay investment during that period of time, and that's why the overall economic activity declines. But there are two other channels. The second channel is the fact that the drop in skewness makes the capital more riskier. So it is actually very common, in a sense, to very similar to the shock to the second moment, to the dispersion. But of course, it's not a dispersion, but this channel is also acting. And the third one is actually connected to the fact that the decline, the skewness, result in the widening of the left tail of the firm productivity distribution without increasing the corresponding right tails. So actually, there are more firms that have a low productivity, and that's why it's not a good time to invest in general for the firms in the economy. So this is the results of the paper in the nutshell. And first, to start the discussion, an important thing is it's a really great paper. It's a novel one. It's really well defined. It's really well written. It was really nice to read it. It's very, in a sense, the message that it delivers is very simple. It's also very concise. So in a sense, from a discussion perspective, it's not an easy point. It's not an easy starting point of the discussion. Okay, so but I found some issues that are actually, I think it's good to discuss a little. So I will start with some minor issues, and the last thing that I want to, in a sense, expand more is a little bigger one. Actually, it's not an issue that is related to the paper, but actually rather to the question, what does this result mean? Okay, but I will be more precise on that later. Okay, so my first remark is actually connected with the fact that this Kelly skewness, so the measure of the skewness that is used in the paper, which of course has its pros. Okay, it's actually quite robust to outliers. Okay, it has a very nice interpretation of the shifts in the distributions. But actually, it also has some cons. Okay, one of the cons is actually the fact that it's neutral to changes in the tails of the distributions because it does not take the tails into account. Of course, when you think about the tails as of the outliers, that's okay. But actually, it could be quite problematic because there's a literature that shows that especially the right tail of the distribution of firms is usually fat and is governed by some kind of the power law. Of course, this argument is rather connected to the levels of the firm's size, but actually it also usually applies also, at least in some part, also to the changes. And what's more important, as showed, for example, by Gabash in this granular kind of argument, that the firms in the right tail tend to govern the business cycle. They are very important. And the appendix for the paper, it shows the main empirical results for different cutoffs for the distribution for this Kelly skewness. But I think it could be quite desirable to see also the results for kind of the regular third central moment of the distribution. Although I'm given the fact that the results are very, very robust, I don't think whether it will change the result, but at least one need to think about it. That forgetting about this right tail is in a sense very huge, could be very huge simplification. The second minor thing is the fact that actually the paper, there are regressions on the skewness versus the GDP. And there is, for sure, in a sense, the paper says that the GDP or the skewness actually affects GDP. So there is in a sense, the endogeneity that is quite, that's in a sense that the paper is talking about. So of course, these estimates they need to be instrumented, or these regressions need to be instrumented in order for this bias actually to be addressed. The third thing is the fact that it's, in a sense, the nature of the shock that is hitting the enterprises is quite important. The paper concentrates on the shocks to the total factor productivity, but actually this time-bound skewness may also apply for the demand shocks. And there is a paper by Kumar and Zhang that actually uses the informational inventories to filter out from the microdata the demand shocks, and then actually they, in a sense, put this production function estimations that is due to Ackerberg, Caves, and Fraser, and to identify TFP shocks when controlling for the demand shocks that is, in a sense, filtered out previously. And of course, it's in a sense allows to better estimate the TFP shocks, but the pros of this approach is in fact that you will get both demand and supply shocks, and actually it is possible to check what are the properties of the third moment of these shocks. And this distinction between the demand and supply shocks are quite important, because, for example, Acemoglu and the others show that in a sectoral network, there are different kind of propagation mechanisms of the supply and demand shocks. And usually supply shocks propagate downstreams because supply shocks usually affects cost, and these costs are passed into the consumers. And the demand shocks usually propagate upstream in the production network, because when I have a demand shock and my production increases, actually this increase of the production are passed to my suppliers because I want, for example, more different materials that I use in my production. The fourth thing, so the fourth issue is actually one of the question. Have you noticed any differences in the skewness changes within the business cycle of firm level shocks, of firm level outcomes, and from industry outcomes? Because in a sense, these are the three levels that the skewness is observed: the shocks to the firms, the outcomes of the firms to these shocks, and actually the outcomes of the industries. Because as I will discuss in a moment, actually the propagation of shocks within the economy could imply that actually this skewness changes at these three levels of aggregation, of three levels of decisions, actually could and possibly should differ when you take into account the fact that the economy is, in a sense, interconnected kind of enterprises. And one of my main points that I want to arise is the question: what does actually this procyclicality of skewness mean? Okay, what is the source of that? There are some attempts in the paper actually to interpret these movements in the skewness, but the authors rather treat it as some kind of the technical feature of the distribution. Okay, so there is very small part of the paper that shows that it could be connected to the bankruptcies of the firms during the recession, but actually it is a very tiny tiny share of the paper. My point is actually that this procyclicality of the skewness could be some kind of the reduced form of the economic structure, which is not present in the model, which of course means that actually it is, in a sense, start of the roots, that exploration of that could be quite interesting. What I'm thinking about. In a sense, shift in a sense, this changes in the skewness means that there are shifts in the mass of the distribution. And these shifts indicate that the shocks that are hitting the firms are quite similar, or are commoved, in a sense, are correlated. And of course, it's not only the outcomes, it's not only the shocks, but also the outcomes. And it happens especially during recession. And there is a quite recent literature on the production networks, for example, Acemoglu, Carveio, Osgadar, and people like that, which show that the firm and sector interconnections could be, in a sense, a source of such a movements of shocks, of such as changes in the shape of the distributions. Because most of the macroeconomic models actually assume, and this model also, that when you are thinking about the firms or sectors, okay, that are, in a sense, that are in the economy, they are not interconnected. Okay, of course, they are producing their things, and then these things are adding up, but the shocks that are affecting one firm or one sector has no direct consequences for the other. Of course, it is possible to introduce the networks into the system, and there are different kinds of networks. And actually, this literature shows that that networks are present in reality, and their presence actually is quite important, because most of these networks you may find industries that act like a hub, something that is very important, it's very central for the network or firms. And when something actually hits when some shocks hits the hub, actually this shock is easily transmitted into the other part of the economy, and there is a huge co-movement. Between different parts of the economy, between the different sectors. And Carveio and Tabas Saleh actually proved that when the economy gets, or when the sectors in the economy gets more interconnected, actually the correlation of outputs of different sectors actually increases. So there is a more co-movements between different parts of the economy. And these network connections actually imply that firms as sector could, of course, depend on each other in a non-linear way, but it also generates a transversal co-movement that can be visible in the data as both the outcome and the shock co-movement. There is also a paper by Bakai and Fari that shows that when you introduce the CIS production function within these production networks, so non-linearities, and this thing can actually generate significant negative skewness and some kind of the excess kurtosis in aggregate output dynamics, even when the shocks that are hitting the sectors are symmetric and thin-tailed. Of course, this evidence is mainly confined to the sectors, because there are much more data, but there is also some papers on the micro level. So these things actually suggest, or this argument suggests, that this heterogeneous and agent model that is used in the paper could generate skewness, of course, when you take into account that the firms interact with each other, even when there are, in a sense, when the shocks are not skewed. One thing that is connected to these differences of skewness in the different level of the aggregation also, it could be coming from the fact that when you add up, in a sense, okay, so when in a sense, when you have in a sense, skewness can also arise due to in the aggregation. Okay, so when you're thinking about the sectors, so the skewness of the sectors could be different than the skewness of the enterprises. Okay, because the normal result, in a sense, that we have on the third moment implies that when you have two variables, okay, so the skewness of the size of the sum of this variable is the sum of the skewness. Okay, so it is actually hard to generate skewness from that, especially the negative skewnesses, because usually these coefficients are positive. But when you allow for the co-movement between these two variables, so the co-movement between the x and y variable, so actually this argument is non-present, because then the skewness of the x and y, the sum of the x and y variable, depends also on the something that is defined in the literature as the co-skewness. So actually, this is also some kind of the co-movement, but it's more complicated than the correlation. Okay, and
Michal, sorry to interrupt. Time is up. If you could wrap up.
So actually, so summing up, actually, it is possible to have a negative skewness even without actually the skewness in the variables. So also the last thing is I also tried to check whether actually it is possible to see this kind of co-movement in the data, in the macro data. So I just let me show you this slide. Actually, this is the skewness of the TFP. So it is all these graphs are graphed against the output growth, okay, which is on the x-axis. So the TFP skewness is actually increasing within the cycle. Here is the standard deviation of the TFP. It is mostly decreasing. So these are the facts that are common to the paper, and these are two different measures of the co-movement on the firm level. So this is some kind of the time-specific common component of the TFP shocks, and actually it is also positive, which shows that in a sense this kind of argument that I'm posting actually could be true. And there is another kind of measure that shows that what is the share of the firms that actually have negative TFP shock. It is also actually correlated with the skewness. So in a sense, this thing that is connected to the firm level kind of network could be really something that is behind the results of the changing in the skewness. Okay, so thank you very much, and sorry for prolonging my time.
Thank you, Michal. Let's go back.
First, I mean, thank you very much. These are really excellent comments. And many of those are ones that actually I strongly share. Network models you talked about, my students, my PhD students hear from me every week that, you know, I love them. I think that's, you know, in many sub-literatures, they are kind of the way going forward. And I have had conversations with both Emmanuel and David on their work about negative skewness. So in this paper, what we try to do is to take like a model that's fairly standard in the macro business cycle, you know, literature, and to quantify in that context. But I agree that, you know, this is not the last word on it. And understanding, you know, the amplification, the transmission through networks, I think is a very interesting research agenda. One comment I want to make, it sounds technical, but at the end of the day, measurement is important, how you do it, about the Kelly skewness that you mentioned. And for those of you who may not be familiar, I described in general terms, but the Kelly skewness, what it does, it looks at the relative size of the right tail. It can be the P50 or P9050, okay, and the left tail, P5010, and it subtracts the two from each other. So if the left tail is longer than the right tail, you get a negative number. If the right tail is, you know, longer, you get a positive one. Then it scales it with overall dispersion. Now, we often use, you know, the 90th and 10th percentiles for Kelly, and that's what Michal was referring to. Then you are ignoring 20% of the data, right, in the tails. There's nothing magic about 90 and 10. Okay, these are numbers that have become, you know, common. So in this work, like pretty much everything we did, we have also done it with 95 and 5, 99 and 1. So we went all the way to the tails. We have also done the third moment. And, you know, they are robust to actually all those the variations. Sometimes actually, if you get different results, that's interesting too. I won't call that not robust. So suppose that the Kelly fluctuates more than the third moment. That will tell me that because the distribution is a very complicated object, it will tell me that it's more the center 80% of the distribution that is creating the change in skewness, not the very long tails. Okay, again, this did not happen in this paper, but if it were to happen, there's actually information in that too. Because the downside of third moment, as you know, and Hal White wrote a beautiful paper on this with stock market data like 15 years ago, showing that it's so sensitive to outliers that you can get completely artificial kind of patterns. So we do all of them to make sure, and then if it's robust, then we basically go with what we reported here. The other comments, I mean, these are all good comments, and I'm happy to also discuss further later. But thank you very much.
Great. There's a question from Yuri. Large firms are diversified and have access to external credit. This likely means that these firms should be less likely to have big negative shocks to employment and sales. He's wondering if cyclical properties are a feature for maybe small firms.
So in the robustness at the end, we look by size. And you see very little actual difference by size. And the figures I showed you here, the counterparts are for different sized firm bins. You see the same. I mean, the big firms have their own challenges, right? They are in a way well diversified, but they have unions, they have big fixed costs, they have a bunch of other issues. So we did not see. Sometimes when I see, again, I won't call that non-robust, I'll call it interesting, to understand the variation. In this case, it turned out to be fairly similar, which is in the appendix, actually, if you are interested.
Okay. There's another comment from Yuri. Is there anything that policymakers can do to address skewness shocks? For example, increased risk due to skewness should lead to higher cost of capital. Central banks have been trying to compress these premia, and this could be one channel. Maybe there are others.
That's a good question. I mean, skewness shocks are fundamentally micro shocks. And another name for it are, micro disasters. So drawing an analogy to the macro disasters like, Barrow, Rates, and the subsequent literature. These are disasters that happen at the micro level. I mean, any kind of insurance policy, any kind of, targeted firm-specific policy that provides some sort of cushion at the bottom end will help here too. So in that sense, I would say what we are showing is that the low end, okay, the bad outcomes, the downside risk is worse in a way than the way you will typically model. By the way, one thing we did not mention is that, again, I'm going to go from third moment to the fourth moment, but believe me, it actually turns out to be important. The kurtosis in change variables are also very, very high. They are extremely leptokurtic. What does that mean? Well, a lot of the changes in, say, sales or employment and so on, they are not that big. They are around the center, but you do have very long tails. So if you have long tails and the skewness becomes more negative, it becomes extremely painful. That's a good question. I mean, we should think more about it. I cannot think of any macro kind of policy off the top of my head that to address it directly. But I think, it's different than a Gaussian shock with a symmetric change for sure. At least, especially it will cause a lot more, I think, risk aversion response from not only entrepreneurs but also firm managers, stock investors, and so on.
So I have here, I was thinking of a possible macro measure to assess what is the importance of these of this skewness. So for example, in portfolio analysis, usually you look at expected shortfall as a measure of how bad things become once they become bad. So this is a conditional, once you move into a certain quantile, you assess the mass, but also some extreme events. And in your case, you were showing this nice picture in the beginning where you have just the uncertainty shock. So this expected shortfall could be computed for this benchmark where there's no skewness. You just have an uncertainty shock to see how much worse things become. And it also gives us an impression of potential loss in terms of sales, how many people become unemployed, what's the expected shortfall of unemployment given an uncertainty.
Sure. That's a very good point. And actually, it matters for portfolio choice in two ways. So today we talked about the firm outcomes being, left skewed, right? But at the beginning I said the workers' wage changes are also left skewed, and they are cyclical. So for portfolio choice, actually, if you incorporate that, and there's a nice paper by Sylvain and Catherine at Wharton who looks at this. If you solve a standard portfolio choice model with like a standard income process, but then introduce basically procyclical skewness shocks to that, you are able to understand portfolio choice quite a bit better. So one implication would be that if you look at occupations where the skewness of wage changes are much more procyclical, they vary a lot, the skewness varies a lot over the cycle, and they do vary, you would expect from standard portfolio choice that those workers should be investing less in risky assets. And, I mean, I know this is an implication, but my prior was that this is such a subtle thing that will you really find in the data? And actually Sylvain shows that that is true in the data, that in occupations with, more negative skewness fluctuations, you have more of that. On the side that you mentioned in the firm data, yes, it will actually affect how you price firms, right? And definitely it has implications. For example, one strange thing is, in a way, it can rationalize part of the equity premium in a way similar to the macro disaster literature, but here kind of coming from the investors' income skewness and the firms, having a huge potential downside. This is a very broad answer. I mean, there's a lot there in your question that I think is very relevant for investment.
Great, many thanks for this lively session. Let's wrap up as we're exactly at 7:20, and we allow our colleagues to come in exactly at 7:20. Thanks, thanks all. Have a nice evening.
Thank you very much.
Okay. Can you hear me? Okay. So welcome to the fifth and the last session. I'm Tomasz Chmielewski from Narodowy Bank Polski, and because we are going towards the end of the long day, maybe we just start with the first paper in our session. It will be presented by Amartya Lahiri from the University of British Columbia. And well, I have a little bit of ambiguity here because in the program I have the title Banks and Monetary Policy in Emerging Market Economies, whereas the paper says Money and Banking in Emerging Economies. So can you clarify this? So the floor is yours.
Okay, thank you. So let me just start by thanking the organizers for putting this on the on the program. This has been a really cool conference. I just wanted to start with, I mean, the whole issue of this title. I mean, it's actually a very new paper, so we're still bouncing around with what the right title for this is. So so this is, I mean, as with the rest of the paper, it's a bit of a work in progress. So My apologies for switching titles on everybody. I should start by saying that this is joint work with my colleague Victoria Natkowska, who actually was the one who was supposed to present today, but the lockdown has made childcare a bit of a challenge for everybody. So so I'm filling in for her poor substitute. Okay, so you know, very quickly, the basic motivation for this paper was that workhorse medium scale DSG models that are currently in use at most central banks are essentially models that were designed for developed economies. Those were you know, developed in developed economies and tested on developed country data. Since then, versions are used of these DSG models. Various versions are used in emerging economies as well. But these models tend to be adaptations of developed economy versions. And the adaptation is mostly done in terms of the way the model is calibrated or some shock is superimposed on these models. And so we found that to be slightly, you know, a drawback of a lot of these models that were being used in emerging economies. And so, the first question, of course, is yeah, but is there something that is fundamentally different about emerging economies? You know, are emerging market economies somewhat, you know, different in a crucial way from developed economies? And our reading of it is that there are a few margins in which there is a very sharp and important contrast between emerging economies and developed countries. And those mostly center around the financial markets. So most emerging economies have very limited asset market participation or financial market participation. You know, so this is known as segmented asset market. So that's very, very rampant. Very few people participate in asset markets. Few firms participate in asset markets. So that's a generic feature of these economies. There are also very limited financial instruments available in these economies. The financial markets tend to be fairly repressed. There are usually lots of frictions which prevent you know, capital from flowing in and out. And governments often interfere to create a sheltered financial market for government bonds. So that just creates all the conditions for financial repression in these models, in these economies. And lastly, there is you know, often a tendency of fiscal dominance of the central bank by the fiscal authorities. So that also starts making monetary policy you know, a huge challenge in these economies. So we felt that this, you know, talking about emerging economies, one really has to take these frictions on board. Now, just because, you know, there are these differences doesn't necessarily mean that this might matter, but it will matter, at least if you even at a very casual level, if you start thinking about you know, just monetary transmission in the standard way in which we typically are taught to think about you know, money and banking, so to speak. You know, the standard monetary transmission goes through aggregate demand. So there are policy changes which end up affecting consumption, they end up affecting investment. And moment you have you know, segmented asset markets, for example, where a lot of people are not even participating in asset markets, now the direct effect that goes through consumption becomes almost absent. Very few, and you know, so if you take a country like India, you can find you know, even the presence of credit cards and you know, this consumption smoothing through asset market transactions is almost nil. And you know, very few people are actually using you know, asset markets to do any kind of consumption transactions. So the moment you've got segmented asset markets, this direct effect through consumption is almost missing. So then monetary policy just becomes you know, acts potentially through investment, and so it becomes really a credit policy, and that, as opposed to the standard thing of that we think through the lens of consumption, that just doesn't seem to ring true in emerging economies. The second bit is the role of bank finance, which also comes with these are emerging market economies tend to have very limited financial development, which essentially make asset markets very incomplete. So I talked about this a bit earlier. Moreover, the institutional structure in which contracts are written, you know, are inherently not as deep, which essentially imply that it's much harder to enforce contracts in these economies. So that in turn implies that there is, there's very little depth in these, in a lot of financial markets in emerging economies, simply because of incomplete enforcement of contracts. That, of course, makes some part, there's excessive reliance on bank finance firms rely intensively on bank finance in these economies because the other asset markets, bond finance and stock markets are often tend to be fairly rudimentary. And so the transmission of monetary policy through banks then becomes very important. And that indeed is probably one of the main mechanisms through which at least central banks in emerging economies think of why, how monetary policy works through the economy. It's mostly through these banks. So we kind of want to have that. And then there is this issue of fiscal dominance that tends to hang over most of these economies at all times, that central banks often lack independence in emerging economies. Monetary policy has to typically adjust to the fiscal stance very often, and this is when governments are running large fiscal deficits. And so in that kind of background, if you raise interest rates, it tends to worsen the fiscal balance because the fiscal deficit otherwise is given. And when that happens, tightening monetary policy can have very counterintuitive results. So that is often the backdrop in which fiscal policy is done, in monetary policy is conducted. So what we wanted to do was, troubled by all of these things that I flagged earlier, that we wanted to build a DSGE model, a medium-scale DSGE model that incorporates all these frictions that seem endemic in emerging economies. In particular, we want to have those frictions, and then some of these banking frictions we want to build from micro models of private information, in particular defaults and so on, which make enforcement of contracts problematic. We want to build that from a micro model too, so that we can have more structural assessments of those frictions. And we wanted to introduce fiscal dominance into a basic DSGE model, while retaining the standard features that we typically associate with the new Keynesian DSGE model. So we're going to, our big focus, of course, was on financial frictions. So in the structure we wrote down, we have 4 kinds of financial frictions built in. The first is there's limits to capital mobility. So there's going to be, we're going to break interest parity. We're going to think of a open economy, but where interest parity, at least in some assets, doesn't hold. And that generates a sheltered domestic bond market where the government can actually play a role and manipulate interest rates. So there's going to be some limits to capital mobility. That's going to be one friction. There will be incomplete household participation in asset markets. That's this asset market segmentation we're going to build in. We're going to have a direct credit channel embedded, which is going to be somewhat familiar to most people, that firms are going to be dependent on bank credit to finance their working capital needs. So that's just going to have a direct link. But then we're going to have a problem of private information in this model, which is going to generate loan defaults and banking lending spreads or agency costs that are going to show up in the structure because of this private information. So let me just very quickly describe the model. We're going to have households. There are 2 types of households, and this is the segmented asset markets. A fraction lambda are going to be traders. These guys are going to be standard households that we typically see in most models. They have access to banks and other asset markets. But the other fraction, 1 minus lambda, are going to be non-traders. And these non-traders do not participate in asset markets. They're just hand-to-mouth consumers. So that's an extreme version, but I think most of what I'm going to say generalizes to a slightly looser as opposed to pure hand-to-mouth. But that's what we have right now. So lambda traders, 1 minus lambda non-traders. Non-traders are just hand-to-mouth, no asset market access at all. These fractions are going to be exogenously given. So we're looking at exogenous segmentation. We don't have endogenous segmentation here yet. So in our model, it's again, the basic structure is going to be fairly familiar. There are going to be 4 layers of production. At the most upstream, there are going to be intermediate varieties that produce using combining capital, labor, and oil. That's the other feature of emerging economies that's often important, the dependence on oil. So we're going to have oil as a productive input. So intermediate varieties produce using capital, labor, and oil. Then the varieties get combined to produce a domestic composite good. And the final good is produced using by combining this domestic composite with a foreign composite good. And then the capital is produced using the final good. Okay, so that's the four layers of production. So of course there are firms all the way up and down the chain here, but the ones that are most interesting are the ones that are producing these intermediate varieties, because there's going to be some frictions there, and the ones that are producing the capital good, because that's where the private information is going to show up. So let me just talk. These intermediate goods firms are, otherwise standard because they're, they face competitive factor markets. They're monopolistically competitive, but that's where the price setting friction is. Their price setting is subject to the Calvo friction. Otherwise, these guys are pretty standard. But with one caveat, that firms must borrow to pay a fraction of the wage bill. So they need to have access to loans which finance a fraction fee of the overall wage bill for them, this is the wage in advance constraint, which creates a credit channel of monetary transmission. So that's one friction over there, which is this direct credit channel. Then we have these investment goods firms. These are two-period lived. So we're going to have investment goods firms which are run by risk-neutral investors. We have two-period lived investors. What these investors do is they convert final goods into investment goods. So investors are born, they have no resources, they borrow from banks to purchase the final good, and then that final good they convert into investment goods. But that production of investment goods is subject to an investor-specific productivity shock. And the output of this good is realized next period, and then all contracts are cleared. So in terms of this investor-specific shock, that's where the private information is. This is revealed after the investor has borrowed, and it's known to the investor after he has borrowed. The bank can verify, but only at a cost Q. So this is a well-known structure going back to Townsend, that this kind of structure leads to the standard solution is a debt contract, which specifies a loan rate and a threshold productivity state, that all productivity realizations above a threshold will trigger default, below a threshold will trigger a default. And if default happens, the bank pays the cost Q, verifies, and sees it all out. So otherwise, it's a standard model, but there's going to be an agency cost that's built in here. There are banks. The banks do standard things like taking deposits, making loans to various. The key parts on the bank asset side that are important here is that the banks are going to be holding government bonds. So they're going to be, and they're also going to be issuing foreign debt. But this bank foreign debt is costly to manage. So essentially, we want to break interest parity. So the way we break it is by introducing some costly banking. So it's going to be costly to manage this debt. And so that's going to break interest parity of the government bond interest rate with the foreign interest rate. And so once we break that, this interest rate on the government bond will become an instrument that can be used by the policymaker. So the government in this economy has three instruments: money growth rate, the interest rate on the government bonds, and fiscal policy. We're going to assume that this interest rate on government bonds is set according to the Taylor rule. Fiscal policy, we're going to assume is exogenous. In particular, the fiscal deficit is going to be exogenous, and that's our fiscal dominance. And then this mu, the rate of money growth, is going to endogenously be determined to satisfy the budget constraint. So there are lots of mechanisms at play over here. The interest rate policy through the bank balance sheet will affect lending rates to firms and deposit rates. So that's going to be having both an output effect and a saving effect. Interest rate policy and fiscal policy combined together will affect inflation through the government budget. Both of them will impact the government budget because fiscal policy is exogenous, or fiscal deficits are exogenous. Segmented asset markets are going to generate a real effect of money shocks. And then, of course, we have the sticky price friction, which is going to generate the standard real effects of aggregate demand shocks. So we calibrated this model mostly to Indian data from 2000 to 2018 to obtain target moments. When the data is not available, we use information from 6 other, small open economies that are listed over there. So let me just show you the basic results here. So first up, does the model, it has lots of bells and whistles and lots of moving parts. So, the concern always is it giving sensible things? So here is the first set of responses to productivity shocks. And as you can see, when you get hit by an aggregate productivity shock, the model behaves like a standard RBC model. output goes up, consumption goes up, employment rises, employment falls here, and that's because of the non-traders. That's the key part, and I'll come back and talk about it. That's the part that is a bit different, and this is where the segmentation begins to matter. And then, of course, you've got investment behaving the right way, inflation falls. So I'll come back to this employment issue, and that's because it's going to be a key thing which is distinct about this model. Monetary policy shocks, again, have very familiar responses. The tightening of monetary policy causes contractions in output, consumption, inflation falls, etc. So all of that is good. And then you've got the government spending shock with the fiscal shock. So a fiscal shock causes output to go up, investment to go up, employment rises. But here is the key thing, that when you look at consumption, consumption is also going up. And consumption going up is often a bit difficult to get in these in standard DSGE models with fiscal shocks. And it happens over here because of these non-traders. As there's a fiscal shock, what happens is, it's these non-traders who can't really smooth, and their consumption begins to go up. And that is driving most of this consumption response, that why consumption is rising overall. So there are lots of frictions in this model. So I'm just going to, in the interest of time, I'm just going to show you the sensitivity of the importance of the price stickiness. How important is that? And the reason this is important is because there are some studies which try to figure out how sticky are prices in emerging economies, and they tend to be a lot less sticky than price stickiness in developed countries. So prices adjust more quickly in emerging economies. So if you, instead of 3/4 of stickiness, which is our baseline model, which is the blue responses, the red ones are if there's just 1/4 stickiness, which some studies on price stickiness in India and Brazil reveal. As you can see, the output responses, quantities become, do not really respond much to monetary policy shocks anymore. On the other hand, prices do a lot of the adjustment, so that should not be too much of a surprise. If you get rid of the price stickiness or reduce it, quantities are going to become a whole lot smoother in response to output to monetary shocks. The same thing happens in response to the government spending shock. In fiscal shocks, if you hit the model with fiscal shocks, if price stickiness is very low, there's not much price stickiness. Once again, there is a lot of smoothness on output and real variables, even though, and the reason is because now prices are doing most of the adjustments, so quantities don't have to quite move. So that is, clearly something that is a problem in emerging economies if you're relying on policy to, because it doesn't really have much direct effect simply because prices are much more flexible. But this is where the limited participation becomes important. So this is now contrasting impulse responses to monetary shocks when you have, under the benchmark case, with another world where the segmentation is much larger. So if you increase the degree of segmentation, so increase the number of non-traders or the share of non-traders, that's the red. And now you can see interest rate monetary policy shocks become much, generate more volatile responses, both on impact and then on the way it comes back much faster. So it responds more and it's more volatile. Most importantly, as you see, it flips the response of both employment and investment. They kind of move in opposite directions relative to the benchmark as you increase the share of non-traders. And so effectively what's happening in this model is that when you have these interest rate shocks hitting, the non-traders actually want to try and smooth things out. So, things have gotten tighter. Their wages are falling. So these guys, non-traders, the only way they can smooth is by raising their, labor market participation. So they work more. And so that's causing employment of non-traders to go up. If you increase their share overall, aggregate employment goes up. And that's why the red line is going up. And that, is mimicked on the investment side as well. And that's what, as employment rises. And then the last thing I want to show you is the response, the effect of limited participation on the government, when you're getting hit by fiscal shocks. And once again, it accentuates when you have more segmentation. Fiscal shocks have a more volatile, have a bigger effect, and they respond much more faster than with limited when you have more participation by in asset markets. And once again, the employment response flips. So here it's the opposite. Once again, it's the non-traders whose employment actually is going down in this when there's a fiscal shock, and that's because wages are rising in response to the fiscal shock, and so they smooth consumption by reducing employment. If you increase their overall share in the economy, they start dominating, and overall employment goes down. And so this is where the employment effects are really, really sensitive to this limited participation. So there's lots of stuff in the paper. I just sort of, conclude very quickly by saying that, in emerging economies, prices are much more flexible than in developed countries, which makes monetary transmission more muted. So if, so the way to think of monetary policy is you've got to think through the lens of just straightforward credit policy and through segmented asset markets. It really works much more through those mechanisms. The direct standard price stickiness method is not quite as powerful. Financial frictions are very severe, and it really comes through segmented asset markets, make things very, very, this constraint very, very strong. And they often induce, and one of the things that it gets us, the segmented markets, is it can allow you to explain positive consumption responses to fiscal shocks, which is a feature in the data, but sometimes hard to produce. One other thing that I didn't have time to show you is that in this structure, at least based on the current calibration that we have, agency costs and bank frictions, which seem like, a kind of a thing that everybody thinks of that might matter here, they seem to have very limited effects in the model on monetary and on the monetary and fiscal policy effects. Agency costs and bank frictions don't seem to change the response too much. That may be an issue of calibration. We're still working on it to understand it better. But I'll just stop there. Thanks.
Thank you very much. And the paper would be discussed by Dmitry Mukhin of University of Wisconsin-Madison. So, Dmitry, the floor is yours.
Thank you. Thanks so much. Can you hear me?
Yes.
Okay, perfect. Okay, let me share the screen. Okay, can you see my slides? Can you see them?
No, not yet, not yet.
No?
No.
Okay, try again.
Yes, now we can see.
Oh, you could see. Okay, sorry. Then I'll do it again.
Now.
Okay. Okay, so thanks so much for inviting me. It's a great conference and also great opportunity to discuss.
Sorry, now we cannot see the slides.
I think there's a lag. There's probably some lag. So let me just wait a second and check whether you can see it.
Have you switched to the full screen mode?
Yes, I did.
So I think this causes the presentation to disappear because it is as if it is sent to another screen, probably.
Okay, so what should I do? Sorry.
So you should switch off the full screen mode. For presentation, just escape.
Okay, can you see now?
No, not yet. Yes,
Okay,
now it's okay.
Okay,
Now it's
great,
okay.
Great. Thank you. Yeah, sorry about that. All right, so let me start finally. Okay, so I'll start by talking about kind of where I see this paper, right? Just let me put it in the context and go back to 1980s when the first RBC models were proposed by Killington and Prescott. And we know that even though, I mean, obviously as any model, RBC model has its own problems, right? We know that it is not a great model of asset prices. It has some problems with the labor supply elasticity, things like that. In general, it was a super successful model, right? So as a model of the business cycles in closed and relatively developed economies, it was super successful with just one shock, and just maybe two equations, the Euler equation and the law of motion for capital, it could match simultaneously the key moments of the business cycles, right? The relative volatilities, the correlation across macro variables, the autocorrelations, things like that. And then we know that this became a main building block of GSG models. In the 90s, people started adding sticky prices, then financial frictions, but kind of the core of the model remained more or less the same. In 1992, 93, several papers emerged which tried to do the same exercise for emerging economies and for relatively open economies, and started looking not just at what happens within the economies, but also what happens between the countries, right? So this is the papers by Backus, Kicha, and Kydland, the papers by Mendoza, and it turned out that these standard RBC models perform much worse once we look at emerging economies and at these international dimensions. Right, so for example, there are well-known exchange rate puzzles, which we know that the co-movement of exchange rate with other macro variables is very muted, right? There are no fundamental macro variables which can explain, predict exchange rates. The PPP puzzle about the co-movement of exchange rates and CPI, PPI, the Backus-Smith puzzle about exchange rates and consumption, the UIP puzzle about exchange rates and the interest rates. And one could argue that maybe we don't care about exchange rate because this is just another price variable, but it turns out that even in terms of allocations, these models perform quite badly, right? We know that there is the Lucas puzzle, the Feinstein-Karaoke puzzle, and several other puzzles about where the capital moves. So the model would predict that the capital should move from capital abundant countries to capital scarce countries and move to countries which have crisis, and that's not what we see in the data. So that's I think kind of one of the key challenges in the international economics and maybe more broadly in macroeconomics. And so how did the literature try to make progress? Well, just as usual, there are kind of two approaches. One can try just one mechanism at a time, adding one additional friction or adding one additional shock. So keeping the model as parsimonious as possible and check whether that one mechanism can explain several puzzles at a time. Or alternatively, one can look at the quantitative model, take several additional mechanisms, several additional ingredients which we believe might be important in practice, and then simulate the model and check whether such model is successful in explaining the data, right? And presumably such models should be more useful in doing forecasts and policy analysis because they take into account different channels. And so this is where this paper belongs, right? So it tries to use a relatively well, it's not a really large scale, but probably medium scale DSG model with several additional mechanism ingredients trying explaining the business cycle in emerging economies. So let me go very quickly over the main ingredients. So I put in blue the key agents in this model and in red the key frictions in this model. So there are two types of households, right? There are traders which hold capital cash deposits in banks and foreign currency bonds. And then there are hand-to-mouth consumers which just consume their labor income and they don't hold any assets, so they can't save or borrow. Then there are firms which produce the final consumption good, so they use oil as an input, and the key two frictions on their side are sticky prices and working capital constraint. And then there are entrepreneurs or different type of firms which produce investment goods, and the key friction for them is the costly state verification. So that creates the wedge between the borrowing costs for them and the capital coming from banks. So the key function of the bank in this model is that they intermediate funds across countries and also within the country. So they get money in the form of deposits or foreign currency bonds, and then they give loans to firms and entrepreneurs. And the key friction for them is that they are required to hold part of their deposits in forms of government bonds and in form of reserves at the central bank. And finally, there's the government, which is pretty standard. So it just has exogenous taxes and spendings, and the monetary policy is conducted according to the Taylor rule. And the model is also very rich in terms of shocks. So each production sector has its own productivity shock. There are monetary shocks, government spendings and tax shocks, the oil price shock, the world interest rate shock, and the foreign demand shock. Okay, so given that the model is really rich and there are many results in the paper, let me just focus on one. And I think that, after seeing Amartya's presentation, I think this is also what the authors think is kind of their main result. So let's focus on the monetary shock and see which frictions, how different frictions change the results, right? So let me just once again, we're going to look at the frictions on the household side and then different frictions on the firm side. So starting with price stickiness, as Marty already mentioned, it's completely standard, right? Unsurprisingly, if you go from high price stickiness from blue lines to the relatively low price stickiness to the red lines, then you see that the response of real variables becomes much more muted, while the response of nominal variables, inflation, exchange, nominal exchange rates, money, becomes much larger. So that's what we would expect from such model. So perhaps more interestingly, and that's what I think Marty didn't have time to show, is that these frictions, financial frictions on the firm side, don't play such a big role. So for example, if we look at this costly state verification for investment firms, for entrepreneurs, it turns out that this friction barely changes anything in terms of the response to monetary shock, right? So the red and blue lines are almost on top of each other. Similarly, if we look at the friction at the producers of the final goods, the working capital constraint, we see almost the same thing, right? So there are some small changes in terms of output and consumption in the very first period, right? So this is where this constraint is perhaps most binding, but after that, there are almost no differences between the model with this constraint binding and when this constraint is almost not binding. So what is the financial friction which matters most in this model? Well, it's the share of hand-to-mouth households, right? So it is the participation of households, and again, as Marty already said, it changes the sign for some variables, like for example, for employment and for investment, and even for the variables for which the sign remains the same, we see that the magnitudes, the responses to the monetary shock increase by about 3-5 times. So it's really dramatic change in the response of the economy. And so this brings me to my first comment. So, I mean, this is like in a tank model, right? Two-agent New Keynesian model. And we can compare this result with the results known from the previous literature. And so what surprised me a lot is that these changes in the magnitudes are so large. And this is in contrast to most of the previous findings, right? So probably the most stark version is given by analytical paper by Van Werning. So he has this as-if result. So he shows that under certain assumptions, the aggregate Euler equation is independent from the completeness of asset markets. So you can have one representative agent, or you can have hand-to-mouth agents, and their share can be close to 0, or it can be close to 1. Still, the aggregate Euler equation, and hence the response of economy to the monetary shock, will be unchanged. It will be exactly the same, right? And the intuition is that there are two effects, right? There's direct effect when the monetary policy changes the interest rate that will affect traders. It will affect the agents which are at the Euler equation. And so this effect, this direct effect, will of course decrease as we increase the share of non-participants, as we increase the share of hand-to-mouth agents. But at the same time, there's indirect effect which increases. So namely, the income of hand-to-mouth will increase, and because they have very high MPC, they consume everything that they earn in this period, their indirect effect of the monetary policy will increase. And so what the paper by Werning shows is that these two effects, they cancel each other exactly. And so no matter what is the share of hand-to-mouth agents, you always get exactly the same aggregate effect of the monetary shock. So clearly, I mean, this result relies on some particular assumptions, right? And so what are the key assumptions? It is a cyclical income risk, so that there's kind of no redistributional effects between traders and non-traders, and a cyclical liquidity, right? So that kind of let's say the number of bonds in the economy stays the same. So clearly these assumptions are violated, right? There's cyclical profits, which traders do get and non-traders do not get. There's international borrowing, which probably is excluded by this acyclical liquidity assumption. So it's not surprising, right, that the result doesn't hold exactly. What is surprising is that in most Hank models, which are usually very rich, in which these two assumptions do not hold either, still in terms of quantitatively, the Hank models usually produce aggregate inputs responses which are very close to the representative agent models, right? They use sophisticated data sets, new micro level data. They have a lot of different channels relative to the standard New Keynesian model, and yet once we see the aggregate inputs response functions, they usually look very similar to the representative agent models. So I'm really very curious, very interested what is kind of different in this model. So it's probably some interaction with other frictions. So, I mean, right? To discover that, you need probably to run some other counterfactuals in this laboratory. So this is my first comment. I want to understand better the key mechanism of this model. The second comment is about maybe some missing international frictions, right? So in this model, in this paper, there are a lot of financial frictions within the country and nominal rigidities within the country, but there are not many frictions actually across the countries, right? So outside of the country. And if we think about the goods markets, one of the key frictions, let's say, that was proposed in the recent literature is the wide use of dollar in the international trade. The fact that most import and export prices in global economy are actually sticky in dollars rather than in the currency of the producer. So I can show you very quickly this picture, which is based on the data collected by Gita Gopinath and previous authors. So this is a share of producer currency in exports, and you can see that except for the US and a couple of European countries, it is actually close to zero for most countries. And this is the share of dollar in imports, right? And you can see that for most countries, both emerging economies in Latin America, but also for India, even for more developed countries, the share is pretty high. It's actually, for India, it is close to 100%. And so that might be an important friction to take into account. So another type of friction is in the international financial markets, right? So Amartya mentioned that there are some limits to capital mobility, right? So for some agents, for banks, for example, or for government, there are indeed some constraints, but it seems like households, the traders, they can still freely trade local and foreign assets. And as a result, the UIP actually holds in the model, right? So this is one of the building blocks of this model. And we know that in the data, it performs quite badly. And I mean, in our joint paper with Oleg Ishoki, we actually show that it is crucial for understanding all these exchange rate puzzles, right? So as long as this is a relatively open economy for which the exchange rate matters, this UIP shocks, these deviations from the UIP might be very important, right? And so then another type of friction which other literature has emphasized is the original sin, right? The fact that governments in developing countries, they usually can borrow only in foreign currency, but in the model, the government actually borrows in the local currency, even when it is borrowing from abroad, right? And finally, there are no collateral constraint, which underlines the sudden stop literature by Mendoza and Bianchi. So in some sense, the international asset markets are not complete. There is just two maybe bonds which are traded internationally. But on top of that, there are no other frictions, right? And so the model probably gets quite close to complete risk sharing because of that. And my final comment is that, so before doing any policy analysis, before doing some counterfactuals, we are probably interested in the goodness of fit of the model. And I mean, I understand that this is the paper is very at the early stage. So it is just one of the directions to go in the future, that probably we need some section. We need to evaluate whether this model with all these frictions, whether it can match the data well enough, right? So the current draft focuses on the impulse response functions, and one can take the estimates from the VAR literature and try to compare them to the simulated ones, or alternatively, which is probably much simpler, one can just calibrate the model with all shocks, calibrate the relative volatilities of these shocks, simulate the model and get some unconditional moments, right? And I would be really interested to see whether the model can match the key business cycle moments from the literature. So in particular, one can do a horse rate, right, to check whether to horse rate between this model and the model with less ingredients, less frictions, to see which friction is the most relevant for the model and to match the data. Also, given that there are so many shocks, it would be interesting to see which shock in the calibrated model accounts for most of the business cycles. I guess I'm probably out of time, so I have several minor comments which I hope will be useful to improve the paper in the future, but this is probably, I can just send it to the authors. So let me stop here.
Thank you very much. And could I ask Amartya for answering some of these comments, if you like, of course.
Okay. Well, thanks, Dimitri. The super comments, really, really helpful. As you said, this is somewhat of an early version, so we're still trying to find our way and trying to figure out exactly what's going on. And let me just start in chronological order in which you made the comment. So, so I think that, you know, this issue of the costly state verification and working capital constraints, they don't seem to, you know, I think what's going on in the structure is that these constraints affect the steady state of the model. You know, so the absolute steady state levels actually are pretty, you know, there's strong effects there. They don't affect the transmission that much. So, I mean, you know, so once, because all we're looking at are these impulse responses in response to shocks for a given level of, you know, agency costs, for a given level of, as measured by the costly state verification. So what I learned from this was these frictions have an effect on the long run levels of output and long run levels of variables, but the transmission to shocks, of shocks to the real side, it's almost as if it's like, you know, it's like, you know, a linear model, you know, wherever you start, it just is moving the same way around that. And so that's something that, you know, is a feature that, you know, once I see it, now I kind of see that's what's going on, but that's something that we're trying to think about when can, you know, it have not just an effect on the steady state, but also on the transmission. But these two financial frictions seem to really affect the steady state more than the transmission. That's sort of, you know, and it's probably not the best feature of the model, but it's something we're thinking about. The aggregate response, why it's different is, I mean, yeah, we've had this, you know, question. I mean, I think it's an interaction between, because we have so many different margins, and that's one of the problems with having these medium scale models that, you know, you've got a lot of margins going on at the same time. And so I think it's the interaction that is creating, you know, bigger deviations from what the aggregate structure would say. I mean, you know, the Hank models do have, you know, some of these frictions built in, but I think we have more frictions in there. And so that causes, I mean, this interaction is causing it, but this requires more digging. You're absolutely right. And we're going to try and dig in a little further into this. In terms of, you know, uncovered interest parity, I mean, we could actually shut down interest parity on households completely. I mean, you know, we don't need these guys to be to access international. We just wanted to have, you know, at some level, not to heap too many frictions at the same time, or we already had so many that we wanted to at least keep some aspects of it, you know, familiar to people. But I mean, that's an easy thing for us to do, to shut down all international borrowing by households completely. And then, you know, there would be, and it's probably fairly realistic. I mean, you know, look at emerging economies, very few households have access to international bond markets anyway. And then you've essentially got, so it's just going to accentuate, it's going to operate almost like a closed economy in terms of a lot of the transmissions, except for the trade side, where there is trade in goods. And so that, and that is something we've definitely thought of, that I think it may not be a bad description of a lot of emerging economies, not Latin America, but certainly in, you know, in Asia, for example. There are lots more frictions to capital flying in and flying out. I mean, you know, there's not that much unfettered capital mobility in India, for example, amongst the larger, you know, emerging economies. So we can certainly introduce that, and so it's a good suggestion. We'll probably, you know, think about that. You know, the government borrowing in this original sin, I mean, this is part of capital controls that were imposed. I mean, so we started doing this because I was at spending time associated with the Reserve Bank of India. And so, you know, this was a model that was essentially, we began building it to help the RBI come up with a structure. And one of the things about, so a lot of the calibration and the structure was motivated by features of India. And there, the government has this clear restriction that, you know, it doesn't have India's sovereign debt outside in terms of US dollars is very low. But yields on domestic currency assets are, you know, very high. So there is a huge excess demand for government bonds. So they've capped how much foreigners can hold, and that's where that constraint came in. That they allow foreign portfolio investors to buy some, you know, domestic bonds, but it's only up to a certain limit, and so it's all domestic currency stuff. But that constraint was motivated by the Indian experience, as opposed to But that's that is the current state of affairs in India, and they don't issue sovereign bonds. India doesn't borrow borrow abroad in terms of issuing sovereign bonds on a regular basis. So, but this is something again that is I think is a good margin to exploit, to try and see how it matters if you say that you cannot borrow in domestic bonds. The fit of empirical moments, that's exactly what we're doing right now. I mean, that's clearly a big goal. We just ran out of time. I mean, and so that's precisely what we're doing. We're starting with the unconditional moments, exactly as you said. That's what we're trying to match up with, and then we'll see how. I mean, the other one is more complicated to match impulse responses from VARs. But this one is a bit easier and quicker to start with. But we are exactly that's exactly where we are. But super comments. Thanks a lot for. We're trying to take as many of these things on board as we can, and hopefully we'll have cleaner versions very soon.
Thank you very much. We have one question from participants, and could you please answer it briefly? Alexander Sharov asked, don't you think that the major central banks make attempt to reject fractional reserve banking model for direct lending for government and business? Could it be better model for emerging market banking model? So I think it is related to your description of the reasons why the model for the emerging market should be a different one. So basically, the question is about about rejecting fractional reserve banking.
Yeah, I mean, again, this is as I said, I mean, some of these things are the constraints that were put in were based on what we were seeing being a very big component of monetary policy in India. I mean, and fractional reserves are is a key component of there. They in fact they just varied it very recently in response to trying to inject liquidity. That instead of playing with rates, they just start playing with the fractional reserve ratio. So it's one of those one of those monetary policy instruments that used to be much more prevalent and common, but it certainly has declined in importance. In India, it's still being used, but as I said, I mean, even if we abandon that, we will still have this just going through the balance sheet of banks and the fact they are holding government bonds. That mechanism is still there. The other mechanism, which is just going through bank balance sheets, doesn't have to do with the fractional reserve system, but the fact that banks are holding some component of their assets in these sheltered domestic bond markets, they're holding these government bonds, and interest parity doesn't hold on those government bonds, which basically means that interest rate on those government bonds, as they go up and down, it changes interest rates in a whole spectrum of assets which are linked to banks on their other assets. So that mechanism, we can abandon the fractional reserve system, and that would still be there. And that, I think, is the one that we mostly think of as being the key contribution of the paper, because that is a feature that is there not just in Asia, it's been there in Latin America. This issue of repressed domestic financial markets, where governments try to create a sheltered domestic bond market in which they can place debt and at lower interest rates. And the way they do this is essentially by precluding free access to that market, or forcing banks. In the Indian case, they directly force them to hold some government bonds by saying it's almost like they almost call it like macroprudential stuff, but it's been there from way before macroprudential became part of the central banking lexicon. So this is a very common policy of sheltering, of finding ways of placing government bonds. So we have that mechanism. We can abandon fractional reserves. That's not fundamental.
Okay. So thank you very much for a very interesting presentation. And now we'll move to the next paper. It is the intensive and extensive margins of real wage adjustment. And the presenter would be Bart Hobain from Arizona State University. So Bart, the floor is yours.
Thank you, Tomasz. This is a joint paper that I have with Mary Daly at the San Francisco Fed, and it's a continuation of a research agenda we have on the cyclicality of wage growth in the United States, and really thinking about how indicative is wage growth of labor market slack, and also to what extent that feeds through in inflationary pressures. And in that sense, it's actually related to some of the research that Aisha Boushaheen presented earlier on in this conference, as well as the paper by Federica Ravenna and Carl Woese that was presented earlier in this conference. So monetary policymakers in the United States actually don't follow one particular measure of wage growth. They follow a collection of 4 measures. There's 4 acronyms here that might be familiar for those of you who look at the US economy very often, but for those of you who don't. Compensation per hour, that's literally taken from the National Income and Product Account. And then there is average hourly earnings, which is taken from surveys by employers. And then there's the employment cost index, which is used largely for indexation of wages. And then the one that we're going to use is actually median weekly earnings. And Fat, you already referred to the median not really behaving exactly the same as the mean. That's also true in the US. And this is median weekly earnings. It's based on data from the current population survey. It's for full-time workers. It's usual weekly earnings. It doesn't include bonuses that are not usually being paid to workers. So we're going to look at full-time workers, usual earnings, and especially what's important is the median is reported in this, not the mean. And that's going to be important for what we're going to look at going forward. So what's going on, and this is true for many macroeconomic models, is that wage growth is a perennial puzzle. And if you look at median weekly earnings, as I plotted here, versus the unemployment rate, which you can see clearly that there are episodes like, for example, at the end of the 90s, if we have very strong wage growth when we have a very low unemployment rate, and this is real wage growth, is corrected for inflation, deflated by the personal consumption expenditure deflator. But there are also periods where we actually see very strong wage growth when the unemployment rate is high, as I'll show you at the end. While I look at some recent data, that's actually the case at the moment. We're seeing very strong wage growth in the United States in macro wage estimates. That doesn't necessarily mean that individual workers really get big wage increases, as I'll explain in a minute. So the first thing to note is there's not necessarily a clear co-movement with unemployment. There is some negative correlation between wage growth and the unemployment rate, and this is well documented effectively. That's the first documented by Phillips for the United Kingdom in terms of nominal wage growth in the classic Phillips curve paper in 1958. Jordi Galí has done a lot of work recently on the wage Phillips curve. Mary Daly and I also have a paper on that. It's there, but the wage Phillips curve is not particularly, the slope of the wage Phillips curve tends to kind of move over the business cycle. And what's going on, and this is well documented by labor economists and macroeconomists have started thinking about this as well, is that there's 2 offsetting effects. There's wage growth of continuously employed workers. So they're basically, if you look at we're going to look at a year. So we're looking at people that are full-time employed at the end of the year and at the beginning of the year. We'll call those continuously employed. We'll do some inference about what happened in the middle, although not perfect. So those people, their wage growth tends to be rather pro-cyclical in the sense that wage growth tends to go up during expansions and then tends to be lower during recessions. But the problem is that at the bottom end of the labor market, people tend to drop out of the labor market during recessions. And this is well known since the early 1980s. Mark Bill's job market paper was about it. There's a paper by Solon, Barsky, and Parker. I'm sorry, it says Gary Solon here. There's also research by Eric Swanson. These are largely done by using the PSID. So this paper is really trying to ask, if we take a published aggregate measure of wage growth in the United States, how important are these factors, and how does their importance move over the business cycle? So it's really trying to put these two offsetting effects in kind of a more historical perspective. And so what we'll do is we'll do a formal decomposition of a published measure of aggregate real wage growth. And we're using median weekly earnings here because that's the measure for which we have underlying individual level data. Now, that requires, though, that we use a non-standard decomposition because we're looking at a median and not a mean. It turns out it's not super complicated, but we'll have to do a little bit of kind of a twist on a shift share analysis. And then what we'll do is we'll account for the importance of the components, so whether people move in and out of the labor market and where they move to and where they come from based on whether they're out of participation, into participation, whether they come from part-time to full-time, or whether they come from unemployment to full-time. And then we'll figure out how important each of these components are for real wage growth. So we'll relate this to the flows into and out of full-time employment. The labor literature on this has often done this based on demographics, but we'll really focus just on labor market flows, and that's also largely because a large part of the current literature is really focusing on the link between labor market flows and unemployment. So if we want to understand the link between labor market and unemployment, as well as between labor market flows and unemployment, as well as between unemployment and wages, we kind of also want to know how wage growth is linked to labor market flows. And then we're going to show how the relative importance of these effects changes over business cycles, and actually also across recessions. And the COVID recession that we are in right now, although maybe not officially, that depends on how quickly Bob Hall's committee is going to announce that. The COVID recession is really a major exception, as you'll see at the end. So now we're not going to really talk about particularly new effects. These effects have been identified before. We'll call them the intensive margin and the extensive margin to really emphasize that it's about wages going up for people who stay in the market and how people move in and out of the market. But conceptually, it's very similar to a composition effect. Now, these margins have opposite effect on real wage growth. The intensive margin contributes to the pro-cyclicality, and it actually contributes positively to wage growth because people who stay in the same job generally get wage increases. But the extensive margin subdues pro-cyclicality, and in fact, on average, subtracts from wage growth because there's entry at lower wages than that there's exit. And so as a result, on average, that actually lowers wage growth to begin with. So in many ways, this is also related to the literature on productivity growth, like Oli and Pecos and studies based on that. Now, the importance varies over the business cycle across recessions and by also the flow source. So the intensive margin is important during expansions, the extensive margin during downturns, and it's particularly important in the Great Recession, the extensive margin. And now it turns out to be really, really important during the current recession. It's really the extensive margin on steroids. There's an outsized role for the part-time margin, from part-time to full-time. But the participation margin is as important as the unemployment one. So the effect of kind of from an accounting standard, we're not doing any equilibrium analysis here or general equilibrium analysis, but from an accounting point of view, the impact on aggregate wage growth from people moving in and out of participation, if you're looking at full-time employed median weekly earnings, is as big for the participation margin as for the unemployed margin. And so the relative importance of unemployment due to two offsetting effects, I probably won't go to get around to presenting those, so let me just skip those in the presentation. So here's the data. So we're using published median weekly earnings. The definition is earnings before taxes and other deductions, and including any overtime pay, commissions, or tips that you usually receive. Not that you're lucky because someone bought a $1,500 dinner and they're paying you 20% in tips when you normally sell burgers. Now, it covers full-time wage and salary workers, and so not self-employed, and it's published at a quarterly frequency by the BLS. And the reason for this is because in the labor force survey in the US, only a quarter of people actually report their earnings. So to get a big enough reliable sample to get the median usual weekly earnings, the BLS waits for 3 months and then bunches those things together to get a sample. I'll show you some monthly results at the end. You'll see it's a little bit more noisy. And of the 4 aggregate wage measures, the median weekly earnings is useful because it's the measure for which individual level is available. It's also based on the CPS, for which a lot of other earnings and income studies have been done. So what we're going to do is we're going to figure out movements within a of workers, and so we need to kind of classify people. So this slide is showing you the categories of workers that we classified. So we'll have people who stay in the same job. We can't perfectly impute that, but if you're employed at the beginning, at the end of a year and at the beginning of a year, and you're still in the same job in the sense that you have the same occupation, detailed occupation, and you're still working in the same industry, then we'll call you in the same job. And that's similar to what Cart and Hislop did in a classic paper in 1997. If your industry or your occupation has changed, we'll call you a job changer. Now, sometimes people's occupation change within an employer. So some of the job changes might be people who get a promotion and their responsibility changes. Then, so they don't necessarily switch employers. The third one is people who move from part-time or self-employment into full-time employment. Then the fourth one is people who are unemployed who move in and out, and then people who move across the participation margin. So how are we going to do this? We're going to use median usual weekly earnings. And really what I kind of want to say is, let's just talk a little bit through where these people move in and out before I'm actually going to do a formal decomposition. So in the data, when we look at people, we're only going to look at people who report their earnings at the end of the year, and then we'll compare them at the beginning of the year. So what we decompose is very highly correlated with the median weekly earnings published, but the median weekly earnings are based on these 2 samples together, and we basically base it on half, and we compare the half of the people report at the end with what they did at the beginning. And so what you'll see is that the bulk of people are full-time employed both at the beginning and the end of the period. And then about 6% actually go from part-time to self-employed. There's at the end, there's a higher entry from part-time and to self-employed. And then there's exit, and that's because part-time jobs are stepping stone jobs towards full-time employment. But what's really important is, where do these people enter and exit? So when you start analyzing the median, what you really want to do is ask yourselves, what fraction of the people who enter and exit make below the median or above the median? So the people that exit, of the people that exit to part-time employment, 64% make below the median, while the people who enter from part-time employment to full-time earnings, 69% after entering make less than the median. So what they're doing is they're basically pulling the distribution of earnings down. If a lot of these people enter, they're all entering at low or below median earnings, and that pushes the median down in the distribution. And so that's a form of what the composition effect of what people have often documented in averages in the PSID. And so what we're going to do is we're going to formalize this. How can we actually capture where these people enter and exit, and how can we capture its effect on the median? And so, of course, because we're looking at a median, we're going to first of all look at the distribution of earnings. So that's F and G. The G will be, and the gammas will be things that everything to do with a G in Greek or in Latin letters has to do with the end of the period, and the F has to do with the beginning of the period. And so at the median, W prime would be the median at the end of the year, and W would be the median log earnings at the beginning of the year. The percentile is just the one at which the distribution function is at a half. Now, what we're going to use is a shift share analysis, actually, but then we're going to do a slight twist on it. So the first thing to realize is, just like means, is that the distribution, the unconditional distribution function is just a weighted average of the conditional distribution functions, and that's what equations 2 and 3 show. Then the next thing to realize is that we could do, like in a shift share analysis, we could now write the change in these distribution functions at any wage as a weighted average of the conditional distribution functions. There will be a component of people that stay, that are full-time employed in both at the beginning and the end of the period. There will be a component of people who enter, and then there's basically a kind of a correction effect of the replacement effect. Who is being replaced in the distribution function? This is going to be really small. So the most important things to think about is just that this is the intensive margin, and this is really where people enter relative to the median, where they enter and exit from, as I showed you in the table. And if you do the same thing for W prime and then average the two of them, you're going to get a very long equation, and I won't be going through the details of it. But basically what you can do is you can decompose the differences in the distribution functions at the median, at the beginning and the end of the period, in components due to the people who were staying in full-time employment over the two periods, and then the components due to the entry and exit into full-time employment, no matter whether it's from part-time, unemployed, or out of the labor force. Then the final thing is that, this is a shift in the distribution function, but we're interested actually in the change in the median. So what we do is we'll apply the mean value theorem, and we'll basically construct a factor, Q star we call it, that transforms the shifts in the distribution function into changes in the medians. And so if you actually do this derivation, it's in the paper, you can consider this kind of a first order approximation in a similar way that's described in the handbook chapter in 14NL. And so at the end, what we're doing is we're doing a linear additive decomposition of all these components where we're using this Q star to translate shifts in the distribution function to shifts in the median. So that's a little bit of statistics and decompositions, but what's really interesting for a conference on macroeconomics and monetary policy is really what it tells us about how wages are actually moving over the business cycle. So let me show you some of the time series results here. So the blue line is the median wage growth that we get from this match sample where we compare people to a year ago. There's a couple of gaps here because the BLS changed methodology or stopped tracking households, and that doesn't allow us to do longitudinal linking into intervals. But for the rest, this is basically what's happening. And what you'll see is that the green line on the top is the contribution of the people who are staying in the same jobs. And you really see that when the unemployment rate slows, so right before recessions at the end of expansions, we have pretty high wage growth in the 90s, and same thing during the long expansion that Bob Hall gave his keynote speech about yesterday. We saw pretty strong wage growth. In fact, at the end, it slowed down a little in the median, and in the US, actually the 25th percentile, which you could also decompose using the method in this paper, actually accelerated faster because there's a real shortage of low-skilled labor in the US. Of course, now there's a surplus of it since a lot of these people lost their jobs in the COVID crisis. Now, that always contributes positively to wage growth. And then the selection effect, people moving in and out, contributes always negatively. But then in recessions, the selection effect moves it up and down the income distribution. And as a result, as this difference between the people who enter and exit out of employment in terms of the wage distribution changes, the effect actually becomes less negative during recessions. And that's extremely pronounced during the Great Recession. So you see it's largely due to movements into part-time employment, but also unemployment. You see it also in the 90s recession, in the 2000 recession and the early 90s recession. If you take the intensive margin and you take the people who stay in the same job or change jobs, remember this in the CPS is not perfectly imputed. You see that this is largely due to people who change jobs. They may have a bigger contribution to the pro-cyclicality of wage growth. Now there's a paper by Mark Girdler, Antonella Trigari, and Chris Huckfeld that emphasizes this as well. There's plenty of other papers that do it. I can't do a full literature review, so let me focus on that paper here. So this is consistent with the results in the literature, that it's largely job switchers that matter a lot when we look at wage growth of new hires in that paper. Now, when we look at the extensive margin, what you really see is that all of them in the Great Recession have this upward blip, pushing real wage growth up simply because of a selection of who's still employed. That's also true in other recessions, but the Great Recession is really, of the 3 recessions in our sample, is really the one where this is the most profound. Now, also notice that that's much bigger of an effect for the part-time employed than it is for unemployed and people who are moving in and out of the labor force. Now, the blue and the green line here kind of move together, as you'll see, and you'll also see that once we'll do a formal kind of accounting analysis of this. What is important, and I want you to take away from this for monetary policy purposes, is that in many ways for monetary policy, you really don't want to, you're interested who becomes unemployed or not. But if you're really thinking about wage pressures, there's you could look at the wages of new hires, but especially what you can do is if you have microdata, thinking about correcting aggregate wage measures for the intensive margin. Because the selection effect might be important. It's going to be very important in the coming months while the economy is in the recession that we're in right now. So if you add it all up, then what you're going to find is if you do a variance decomposition, so the variance of wage growth is largely just determined by these people who are employed both at the beginning and the end of the year. And the very little is contributed through the unemployment margin and not in the labor force, but they're about equally important. And then part-time employment, that margin, the selection margin for part-time employment contributes about 10%. But as you saw already, it's nice to do a variance over the whole sample, but you really don't capture the cyclicality of it and how it's important at different points of the business cycle. Now, one way to do it is just to do a regression of each of the components on the unemployment rate. And that will add up to because it's an additive decomposition, that will add up to the regression of the total wage growth on the unemployment rate. Now, the total wage growth on the unemployment rate, if you do this regression, I did it in 4-quarter moving averages. I didn't do for Ken, I didn't do a new US correction, but we'll do a correction of that for the revision of the paper. But so the t-values, just take those with a little bit of a grain of salt. They might be overstated. But this is a negative coefficient. It's mildly significant the way we've reported the t-values here, but significance is not so important. What's really important is that all of this negativity is due to this intensive margin. So in that sense, you really want to think of the wage growth moving with labor market slack in a world like this by measuring this through the intensive margin, not through the extensive margin. The extensive margin, unemployment is mildly negative, but really movements from part-time employment and not in the labor force, the selection there is pushing wage growth up. And understanding these things is complicated. We don't have that many models of part-time versus full-time employment. Etienne Lallet is working on some papers and does analysis on this. And of course, Aishigul has worked with Richard Rogerson and Toshi Mukuyama and Per Kusel on a 3-state model where you have entry in and out of the labor force, but in that model, the wages aren't moving. So there's still a lot to do to understand that better in the literature. And so this slide is highlighting what I already highlighted. But what's happening is that the intensive...
due to time constraint, we should move to summarizing, if you could.
Yeah, I'll do
you.
that. So what's happening is the intensive margin is offset by the extensive margin. Here's the recent data for the COVID recession. This is monthly data, and it's very noisy, but you see that the intensive margin is really the extensive margin is really important and explains everything, and we see positive wage growth in the US. So let me just say this, that in that context, we're going to see very strong wage growth and aggregate wage measures during the COVID recession because it's hitting different groups so differently. And so using an analysis like this to figure out the importance of the extensive and the intensive margin for any central bank is going to be important in the coming months going forward to better understand to what extent wage growth is reflecting labor market slack. Thank you. Sorry for going over a little, Tomasz.
Thank you very much for a very interesting presentation. And now I would like to ask Moritz Kuhn of University of Bonn for the discussion.
I cannot be unmuted.
Okay.
Sorry.
We can hear you.
Okay. Now I'm unmuted. Very good. Okay. Yeah. First of all, thank you very much for having the opportunity to be part of this conference and to discuss this paper. I guess these are challenging times, but somehow this conference also shows that we, as a professional, are able to overcome also these challenges. So it was like a great pleasure to read the paper. It's wonderful because it formulates a goal, it does what it describes what it wants to do, and it provides the results that it promised. So you, after having read the paper, you're very satisfied. So everything that I can do today is to go through the paper and some of the comments, and I should also, I guess, share my screen at some point. Okay. To go through the paper and give some comments on the results, and in particular try to also provide maybe a slightly different interpretation to the results. Okay, so I guess I don't have to restate that this is an important topic, trying to understand macroeconomic wage dynamics. And I think the important point that this paper is again emphasizing, and I think that we really want to take into account, is that the observed wage growth that we see at the macroeconomic level might be affected by the changing employment composition from workers flowing in and out of employment. And given the time of the day for at least some of us, I'm going to be very light and just draw some nice pictures to illustrate this again. So what the current paper does, so what Mary and Bart have done, is to decompose the wage dynamics, taking into account labor market flows. And as Bart said already, there have been decompositions that looked at the characteristics of workers and trying to see how different workers being employed or not employed over the business cycle affect observed wages. Now they look at labor market flows. So in a certain sense, you could say we have looked at characteristics of workers, and now if we interpret labor market flows as behavior of workers, saying I leave the labor market or stay employed, then this is more now a decomposition along the behavioral dimension of wage growth. So what my discussion is going to do is probably try to push a little bit back and say maybe also these labor market flows are just functions of the underlying heterogeneity, and it's important to take into account that labor market flows are very heterogeneous, and maybe this is one of the insights that you can get from this analysis, that the probability of workers moving in and out of employment is not homogeneous in the population, and that this is something that we have, this type of heterogeneity is something we have to take into account where we want to understand macroeconomic concepts, in particular wage dynamics. So as I promised, I'm going to show you some pictures to just highlight again the key idea and what the paper does. So wages of employed workers, that are these guys here, so they are employed at the factory, they change over the business cycle. It's a good year, the firm sells a lot of stuff, they make high profits and give part of this to the worker, and wages go up. Then there might be years that are not that good, workers get either a wage cut or at least less wage growth, and so their wages go down in a recession. This is what they call the intensive margin of wage changes. So the guys who are at the factory, for them, wages change. Okay, but as we know, this is not everything that happens in the labor market. Unfortunately, in some cases at least, some workers also have to leave the factory, but from time to time, other people come. So typically, in recessions, there are people leaving the factories, okay, employment goes down, and in a boom, there are workers again coming into the factory, so employment goes up. There's this additional margin of like, these people could also work more or less hours. Let me abstract from this for my simple figure here. Okay, this was also part of the extensive margin, these changes in hours. So this, that people go in and out of the factory over time, this is what Bart referred to as the extensive margin. And now the question is, how can these guys here change the observed wages? And I think there we can already make an important first observation when it comes to heterogeneity. Okay, so here I drew a very simplistic wage distribution. Okay, so suppose this is a distribution of wages, it's just a density function, and this is the median. Now, assume that like in a recession, it's not like every worker has the same probability of leaving the factory, but it's really these low-paid workers here that I marked here in red who leave in a recession. So in a recession, it's low-paid workers who leave the labor market, who leave employment. Okay, what happens in this case? So suppose this here in the middle is our pre-recession median wage. Now, all these workers are not going to observe in a recession. Okay, all of them are not going to have a wage because they are going to be non-employed. What does this do to the median? Well, it pushes up the median here. So we get upward pressure on the median wage. So the median observed, okay, and this is always important, the median observed wage goes up. So in a recession, we get from this extensive margin, at least in the, I said the simplest case, we could argue that there's an upward pressure on wages. Now, what's going to happen in a boom? Suppose in a boom, and Bart actually showed these statistics about where people leave and enter employment. In a boom, let's suppose that the newly hired workers are not the CEOs here and the top management people with the high wages, but that are the workers at the bottom end of the wage distribution. Okay, so these workers were all non-employed. Now they come in. The wage distribution extends down here. So this was our wage in the recession. Now in the boom, the wage goes down because I add additional employment here, here at the bottom. So these workers entering via the extensive margin would put some downward pressure on the median observed wage. Okay, so what now the paper does is to say, okay, there are wage changes here for the employed. There are wage changes here that come from the extensive margin. What we want to do is just to decompose the median wage movement, so the growth of the median wage here, and see how much comes from these guys, because things go well, wages go up, and these guys get higher pay, and these guys here going in and out of employment. Okay, and note what is important here is, and I'm going to emphasize this again later, it's important that we have selection here. Okay, it must not be that like everyone has the same probability of leaving employment, but we need a selection effect here on the extensive margin to matter. Okay, so the extensive margin is only going to affect median wage growth if it's not uniform along the wage distribution. Okay, so Bart only hinted at this, but they have this very elegant decomposition of median wage growth based on the data from the current population survey. I'm not going to go through the equations. It's like very well explained and very well derived in the paper. So if you're interested in this, I can highly recommend going through that. Then what they are going to find is that most wage dynamics are accounted for by the extensive margin. I think this is something to appreciate in the first step, because also in the US labor market, it's actually the case, and there's like, I guess we should be aware of this fact, at least since this paper by Bob Hall from 1982, that even in the US labor market that we typically think of as being this very dynamic labor market with hire and fire and people going in and out of employment, still most workers have lifetime jobs and stay with their employer for very long. So having long employment relationships is very typical also for the US labor market. Okay, so, and now we see that most wage dynamics over the business cycle are accounted for by people staying full-time employed over time. Interestingly, in their decomposition, they assign 45% of all workers as job changers. So of the 100% of workers that they observe from like over the year, 45% of them they accounted for as job changers. As a remark here, I would be curious to learn a little bit more about misclassification error, because we know from the work of Komburov and Manovsky that these surveys are very prone to misclassification of occupations over time, so that we might miss like the same work and the same job just with two different occupations. But still, that does not account the whole number. Okay, what I think it still tells us that there must be a lot of changes in wages, and Bart mentioned this during his talk, also along the career ladder. So workers who are maybe in middle management, now things go well, the company expands, so some people get promoted to higher steps on the career ladder. So one conclusion, I think, and one thing to take away from here is that if we want to understand aggregate wage dynamics, probably we also have to go like within existing employment relationships and try to understand better the wage dynamics within existing employment relationships, and to understand things like career ladder dynamics. So who climbs the career ladder, who actually has wage growth with the same employer, and how does this change with macroeconomic conditions. So I think that's one conclusion to draw from this result about the intensive margin. When we go to the extensive margin, that's what I'm going to focus on for the rest of my discussion. What they really show is the net contribution of worker flows. And like the paper has the text first and the graphs at the end. So I read the text and said, oh, that all makes perfect sense. And then I looked at the figure. And then I saw, wow, the extensive margin is on average negative. So mobility in the labor market has a negative contribution to median wage. And I first thought, oh, that's puzzling. So that and that took me a lot of time to understand. And like, I want to let you participate in my thinking and at least provide some examples how I think we can get this extensive margin being negative. It's again very much related to heterogeneity, and I would be curious in like Bart's explanation for like how he thinks about this negative contribution to, at the extensive margin. For me, the key takeaway was we should expect a lot of heterogeneity in terms of labor market flows. So, and that I'm going to comment on later on again. So there seems to be selection across what type of workers or workers in which jobs are going to lose their jobs over the business cycle. And that seems to be of first order importance to understand aggregate wage dynamics. So I think also as macroeconomists thinking about labor market dynamics, taking into account heterogeneity in labor market flows seems to be very important when we think about macroeconomic phenomena. So here are my two examples how I could come up, or that I could come up with why the extensive margin should be negative. So this is just the life cycle dynamics of work. So here you see age, here you see the wage, and this is just this typical concave log wage profile. So workers, when they start in the labor market, have low wages. then over time the wages increase, maybe from human capital accumulation or from finding better and better employers, climbing the wage ladder. And then just before retirement, there might be some downward trend already here, but at least older workers have on average higher wages. So if I now look at the labor market flows, labor market entrants, which would be classified in the CPS as being NE flows typically, they have low wages, and people who leave the labor market have high wages. So that on average would do, just by demographic like dynamics, young workers with low wages entering, older workers with high wages leaving, that would generate you a baseline negative contribution to median wages. Okay, because these people earn above median wages, they earn below median wages. If these people come in, typically maybe even in a boom that presses down the wage, if these people leave in a boom, that this pushes up the median, this pushes down. So that would be one reason why median the contribution to median wage growth is actually negative. But I guess this is nothing to really be very concerned about. If there is a way to like get an estimate out of the data how important these flows are, I think it would be interesting to just get these structural, let's call them structural wage contributions out of this extensive margin, to get like more cyclical and structural decomposition. And another way I could think about how to generate a negative contribution to the median would be about workers and their careers within the firm. Okay, so these internal career ladders, internal labor markets with promotions where people climb the career ladder. So you're a young worker, or maybe even mid-career worker, you enter the firm, you just lost your old job, so you go from unemployment into employment, you have a low wage. Then over time, this is exactly the intensive margin that Bart talked about. Maybe we have one of these long recoveries in the US labor market, wages go up, go up, go up, the intensive margin, and then Corona hits or the financial crisis hits, and you lose your job. Okay, and this is somehow also related to what David Berger presented yesterday with these large earnings losses at job loss. So if you're one of these workers who loses the job after having climbed the career ladder, and now you drop down as a high tenured worker, then you have these large and persistent earnings. So that would be another way how I could rationalize a negative contribution of the extensive margin. Okay. So now, like, what I wanted to do in my last probably two minutes or so.
Well, actually, we should finish right now.
Okay.
So could you please go to the conclusion, because we are time constrained.
Okay. Very good. Okay. So I think the only thing that I wanted to say here is that from a theory perspective, I think we should think about wages and labor market flows to be determined jointly. And here, this is just a point about selection. A representative worker would have a hard time like accounting for the wage dynamics. So what are my conclusions? It's a great paper. You should read it. Very careful data work. The changing employment composition is important to account for aggregate wage dynamics. A representative worker cannot account for the composition effects and will therefore also struggle to account for the macroeconomic wage dynamics. Heterogeneity in labor market flows is definitely something we have to think about when we want to understand aggregate wage dynamics. That's the extensive margin. And career dynamics seem to be another important thing to think about once we want to understand aggregate wage dynamics. That was the intensive margin Bart talked about. It was a great pleasure to read the paper, and it was a great pleasure to be part of this conference. Thank you very much.
Thank you very much. Bart, would you like to answer to these comments? We can't hear you.
two things about Mauriz's comments. Maurice emphasized career ladders. US data are not perfect on that. I think other countries have better data, like Germany, and he's worked on that. I think that's important to realize. We should look at this evidence beyond the US. And we shouldn't forget the importance of the displacement penalty for unemployed workers that's come up in Mauriz's discussion as well, and it's going to be large in this recession. I wanted to thank everyone from watching this over Netflix tonight on Friday night, and all the organizers for putting this conference together. Thank you very much.
Thank you. Any others from attendees or panelists would like to ask some other questions? Okay, so since I see no other questions, I would like to thank you once again, all the attendees or the panelists, presenters, and discussants. It was a very interesting session. And thank you the more that we have, as you mentioned, Friday evening, at least at some parts of the world, it's evening, but it's everywhere, almost everywhere Friday. Thank you once again.
Dear colleagues, dear friends, first of all, let me thank you for being with us in the last 2 days. Yes, on one side, I'm a little bit sad that this year we have not had opportunity to greet you all in the beautiful city of Kyiv and have interesting face-to-face discussions, both during official and unofficial parts of the conference. So definitely this wonderful part of our annual events has been missing this year. On the other side, despite the changes in the conference format, I believe we managed to have a really good and productive discussion on very important topic, both in policy and academic dimension. The issue of granting a mandate on supporting maximum employment for the central bank is debatable from an institutional point of view. However, in practice, most central banks definitely account for labor market developments in the decision making. As has been said by Stefan Ingves, monetary policy is attached to labor market in one way or the other. The discussion on this conference only proved that the proper reaction of central banks during crisis episodes on labor market developments is vital for promoting the prosperity of a state and supporting sustainable economic growth. Central bank reaction is badly needed. As we learned from Jordi Galli paper, the crisis in the EU left scars of persistently high unemployment as laid-off workers lose their bargaining power on the labor market. On the other side of the Atlantic Ocean, it took 9 years for employment to fully recover in the United States after great global financial crisis of 2008. And I refer here to the notes by Yuri Gorodnichenko. It is worrisome that losing a job during a recession may lower one's earning for decades ahead, as was illustrated by David Berger. Even after the crisis caused by pandemic, many of those who lose their job would be required to change their occupation. That was Federico Ravenna demonstrated. And Alexei Krivtsov also mentioned in discussing that paper that makes a quick V-shaped recovery quite improbable. And as was shown by Bob Hall in a keynote lecture yesterday, the recovery of the economy always takes more time than its fall during the crisis. Political economy of the labor markets has important implications for the central bank. To a substantial extent, its very existence in the form of independent institutions depends on employment. Sergei Guriev indicated that the regions with higher unemployment are found to be more likely to vote for the populists. This is truly unfortunate because populism is associated with a negative influence on economic growth. And we can extend this conclusion to have more long-lasting institutional consequences, as populists tend to attack central bank independence. In 2020, as the new invisible enemy roams around the globe, the monetary policy finds itself under pressure to fight unemployment. Central banks contributed a lot in recovery after global financial crisis. However, most of them have less ammunition in the current crisis due to the interest rate on zero low bound, as was discussed by Chris Herzog. Moreover, we learned from Federico Raveno's work that the unemployment consequences of negative demand shock are especially severe when monetary policy is constrained by the effective lower bound on nominal interest rates. Central banks are keen to use unconventional monetary policy. Davide Forcieri demonstrated that it has been at least as much as effective in stabilizing output and contributing to reducing inequality as conventional monetary policy. However, despite all central bank efforts, their ability have limits. Central bank policy is able only to buy time for politicians to do reforms that are challenging, however, and they are able to bring long-lasting results. Additionally, there is a need to support central bank efforts by other policies as the relationship between different central bank goals becomes less obvious. E.g., the link between the labor market and inflation becomes increasingly uncertain due to the globalization and technological development. I refer here to the paper presented by Asik Sahin and the discussion by Slavik Sheremirov. We discussed in policy panel and research sessions issues related to fiscal policy, migration, competition, and structure of the labor market. Reforms that can bring long-lasting results in these spheres are out of scope of the central bank mandate for a good reason. The political will and mandate are in need to implement that. However, we are not helpless. The central banks can use its technological status to attract attention to the most burning issues, providing its unique expertise and research potential to reform agenda. That was Stefan was mentioning earlier today, that in many countries, the central banks are emerging as the centers of economic expertise and research. And I do believe that our research conference was a great opportunity to prove that. On this note, let me once again thank all the speakers and participants of this conference. And the special thanks goes to the organizing team, which includes a lot of wonderful people who worked tirelessly to make this event happen. So I'd like to thank Yuri Gorodnichenko, Mariana Kudliak, Alexei Krivtsov, and all my colleagues from the National Bank of Ukraine. Of course, I should not be silent on how I appreciate the help from our long-standing partners in organizing this event from National Bank of Poland. So I'd like to thank Governor Glapiński, Board of Narodowy Bank Polski, and the staff of the bank for their great support. Also, we thank for the support to International Monetary Fund and Government of Canada. And finally, as you know, the conference this year is held jointly with Journal of Money, Credit and Banking. And let me thank Ken West, the editor of GMCB, for being our partner. So this is it. I keep my fingers crossed that in 12 months, we will be able to greet you all personally in Kyiv and have a good discussion on another very important for the central bankers and academic economists topic. До побачення і до зустрічі в Києві наступного року.